Welcome everybody. Welcome to KCAP Rules University present everything that you need to know before trading options. I know options is one of the topics that is really vast topics, and I bet 95% plus people do not know what options are, or if they know what options are, they don't know how to trade them, or they don't know what actually moves options, or anything regarding options. There's quite a lot of speculations going on with just like I mean options were actually made first for hedging the positions, but then now we can flip the premiums. But we will go over exact the whole thing, what options are, starting from really basics to going to the extreme levels. And let's start. All right, disclaimer. Please, we'll pause the screen. Please read this. I got two disclaimers. Um, okay, and options involve a huge risk and aren't for everybody, man. So if you guys know this already, please stay. Otherwise, just skip. So I'm a big fan. I'm a big fan of the saying called "closed mouths don't get fed," and because now we have 60 people here, and I normally don't do this, but there's a little bonus for everybody here, which before this, it will only last as long as we do the session. After this, it'll just, I'm going to take it off as soon as the session ends. So you guys will have quite a lot of time actually. Um, so if you want to buy my book, just for all of you, man, we got like 60 people. Um, use code KCAP to get 50% off. That comes to the cost of a cheeseburger meal. I'm loving it. So $10 you pay for 4 years of experience, doing 40 pages of straight facts and 100 plus charts and images. Our personal strategies, morning routines, how I make my game plans, making a watch list, support and resistance, trading rules, risk management rules, and much more, all for $10. I mean, what the F, right? um, if you do want to proceed with the book, there's a link in my bio, and it's not mandatory. You don't have to, but if you do, it's for $10, and offer only valid till we finish our class today. So, okay, who this course is for? Like, who should be attending this? If you are thinking of trading stocks options, or you already trading them but losing money, this could be the most useful course you ever study. Like, you'll know everything about how options move, why do actually premiums pay, and sometimes people say it's really hard to place a stop loss with options because um, because what happens is, on a stock chart, you're like, okay, I'm gonna risk 30 cents or 50 cents or $1. But when you look at your option premiums, they take a hit 20-30%, right? So knowing how the options are priced can help you prevent that. Okay, and my goal is to save you time, money, while educating and entertaining you. I do this. I'm a no BS guy. No, there's literally straight facts. Um, I'm not doing this. I have got nothing to sell you guys. I'm just doing this for free, and I really want you guys to do better. The reason for that is, if you guys do better, man, then not gonna lie. Let's say you started doing better, and I helped you out. 3, 5 years, 2 years, 3 years down the line, you started doing better. And guess what? Now I have someone, like let's say you from New York, right? And I have someone in New York, and if I ever need to do any business in New York, and you already rich as fuck now, I know we have a connection now, right? You'll make some money, I'll make some money, and I'm looking at, like, I'm 23 now. I'm looking at 20 years down the line. If I help more and more people, um, just making more and more connections along the journey. And this is why I do it, and I'll save you some time and money as well. People make options seem a lot more confusing than they actually are, but perhaps it's because option contracts are legal contracts. They include specialized terms. All the loyalty talk. As much as possible, man, I'll leave most of the loyalty talk out of the course today. Like, this will be straight, simple. um, you know everyday layman can understand as well. If he watches this video, he'll actually understand you know what options are, how to trade them, and all that stuff. So I tried my best, and if still there's some stuff that was like absolutely necessary. So what's so great about options? Did you know the single best reason for choosing options is that you know in advance how much you can lose? That's one of the best things I like. I swear to God, that's one of the best things I love options. You're in control of how much risk you're willing to take, right? I know right now, if you talk about you're gonna trade premiums, you can't lose 100%, which I absolutely, I agree. Um, but when we're talking about a little bit bigger than trading, like on a macro scale, when you have some money and you want to buy some, stocks for long term for your kids or something, um, and the market's going down, like right now, the markets were going down, and you you want to buy some, you don't know, how long the market can keep going down. So there's ways we can trade options and know in advance that if we jump in 10 contracts, that we can control 1,000 shares, which we will go over in detail. But you basically know if you dump 3,000 in the options, the maximum loss you can take is at 3,000. Nothing more than that. So that's why I love options for my long term. I'll show you how I actually size using options. It kind of prevents your downside quite a lot. Options are very, very leveraged instrument. They're highly leveraged, which means you do not need thousands of dollars to make money. You can start with literally as little as $1,000. I'll be honest. I was talking to a trader the other day just from our Discord. So this dude has taken his account. I think it was yesterday from I think $200. He said from $200 to $4,000 in a matter of a few months. So it was not any crazy returns on an investment where he risked a lot of money. It was just consistently he was stacking the bills over and over again every single day, taking better and better trades. And this is the fun bit about options, that you don't need a lot of money to start with. You can start with like a contract on Apple, probably be like, what, this contract is like $1, 150, 230, 330. So you don't need a lot of money to actually make money in options. One reason you like options is that you can make money no matter what the market conditions are. Like, if the market's going up, there are calls. You can buy calls, and you can benefit from the price going up. And but there's another way to make money, which is to short some shares. There's quite a lot of work to do sometimes. The shares are not available, or you gotta pay the fucking fees and stuff, all this stuff. So with options, it's pretty easy. Like, you just go to the put contract and you just buy the put contract and the price goes down and you make some money. So this is the one reason why a lot of people love options, trading over shares. It's just easy, like, less stress. You got literally no stress. Okay. Last but not the least, it's much easier to short a stock using option contracts, as I said before. Yes, that means you can make money when the stock market or any individual names are going down. So other day I was talking to another trader and he had no idea about shorting. He'd been trading over a year now. The 2020 trader only knew about upside. Um, and he was quite astonished when I told him you can make money on the market going down, because he's sitting on the sidelines just waiting for the. I'm like, why are you not catching the moves downside? He had no idea. So if any of you here out of 70 people have no idea about you can make money on the market going down, yes, you can. All right, let's now. This is all the information, all the introduction, why you need to love options, and now let's jump into what is an option contract. Options are simply legal binding agreements to buy and sell a stock at a fixed price over a given period. So, the difference between options and stock here is, with stocks, let's say it's a stock's trading $100 and you want to buy, let's say, 100 shares. It's trading $100. You want to buy 100 shares, so that means you need this much money to actually buy 100 shares. But if you want to do options and you want to actually exercise it, here you have a risk the price can just keep on going lower and lower and lower. Like with Baba, people thought it just can't go any lower. Or with Shopify, one of my friends have it, and he's still holding his shares from 1,000, and I think now it's trading at 350 or something. So was he in options calls for long-term leaps, which we'll talk about at the end of the session? Like, he knew what he could stand to lose, but now his loss is so much bigger, and he's one of those who just, long-term investors, like, I will come back one day. But mind me not, he have a lot of money. Not everybody can hold a big six-figure, 6-digit plus. Not everyone can do it. I haven't got balls, to be honest. So options are simply legal binding terms that you buy and sell stocks at a fixed price over a given period. There are two different types of options out there. First is calls, and then we have puts. So calls give the owner the right. Like, let's say if you buy a call, it makes you the owner of the contract right there. It gives you the right. Like, you can buy the stock price at the date of expiration, but you don't, it's not an obligation to buy at a specific price. If you chose $100 strike price, that means even if the price is trading 105, the guy who sold you the option contract, he still have to give you the 100 shares on $100. Doesn't matter if it was trading at 300, 400, he still have to sell you at the $100, because for him it's an obligation, but for you it's not an obligation. So puts give the owner the right but not the obligation to sell at a specific price by a certain date. So this can be good for long-term shareholders who are holding a stock and they can sell out of the money puts. Just so there's a lot of ways. We'll talk about this in the end of the session. And there's a lot of ways you can actually make money. It's just not straight buying puts and buying calls, and there's a lot of things that go into this. So with puts, it's a little different. I mean, I can enter a new put agreement and have the choice to sell a stock at a specific price. If it hits the price or not, or or it just goes through it, you have the choice to execute or engage the contract with the person that I have bought that. I think yeah, I'm confusing you guys. I think it will make it easier in the next slide or a couple of slides. Right now, it's just too much information. I know. So don't get confused. I have very simple examples in the upcoming slides, and you'll actually understand. All right, let's go to the three main components of option contract. Like for options, we have three main components. The number one is you got to know the last price of the stock. Yeah, this is very, very important. Like you have to know where the stock's trading at that given time. And then we have how many days to expiration you want. I was making this last Saturday, so that's why it said 6 days. But how many days? If it's Friday, you're gonna say 0 days right here. So you have to know what expiration you're doing. So you can't go long-term leaps if you want to buy this weekly contracts, right? So you want to know what expirations you have. So number one is last price. Number two, expirations. And number three is strike price. And I see a lot of people. Other day, somebody texted me. He's like, I think what name it was. It was Amazon. He sold somehow. It costed him like $5 or something. Amazon's trading at 2,000, 2,100 or something, and he sold like 800 or I don't know, like what he was saying. And I was like, why? Why would you do that? So you have to know how to choose right strike price. And he's like, it was just cheaper. So even if the price dropped, there's no way to make money because there's no delta, and we'll talk about at the end of the session as well. So you have to know what's the price trading at now, what's the expiration date, and what strike price you're going to trade. So these three things are very important. All right. Underlying security price, strike price, expiration date. Okay, now let me jump on IBKR and show you around the option chain a little bit. So it makes your life easy. Okay. So this is what an option chain looks like. This is for Apple. And Apple. And we are trading somewhere around 150, over 150. So this becomes at the money. Like doesn't matter what broker you're using, every single broker will actually have anything that's in the money. If you're quite new to this, please watch till the end and you'll understand what's in the money, out of the money, and at the money. But anything that's in the bluish is always in the money. Okay, this is in the money. So this strike right here is considered at the money because they are trading right at that price. All right, and all these next ones, they are considered to be out of the money. So there are ways to trade this, and there are ways to choose a right contract. So if the price does move, it moves in your favor, you really want to benefit from your put contracts. If it does move in your favor, you want to benefit from your call contracts. Okay, so I will talk about calls first and explain you guys a little bit. But this is what option chain look like. You have bids, ask, just like any stock, and that's for individual names. So basically 152.5 calls are trading at, so you never have a fixed price of these. They're always a bit like with stocks, you can find the fixed price, like where is that stock trading at right now. Like right now, close, I think this is a little bit played up right here. But you can find out exactly where the stock is trading on stocks, you know, but with options, you never know where exactly that thing is trading because we have spreads. Okay. So we have to know if you get in, let's say you hit the mid and you bought at 330, that doesn't mean that option contract is trading at 330. It's just we have bids and ask, and there's hardly in, there is mark price, which we can find out, but just say there's no actually fixed price. There's always a bid and an ask for it. And then these all are Greeks. This is a bit confusing ones. Not really confusing. It just let it go for now. And then we have volume. Every single contract has a volume. Every single contract will have a volume. Like 152.5 had 2400 volume on that given day. This is next week expiration. This is on Friday. And we had 5.79 open interest. And we'll talk about this in detail as well. But this is what an option chain looks like. And if you already didn't know, and now, what are call contracts? What are calls? So these all you see right here, these are calls, as I showed you on the option chain as well. So call contract, a contract that gives the buyer right to buy back the shares at a particular price which was set at the day of agreement. Let's say if you buy this right now, if the market's open and you bought 800 calls, so you are in an agreement with the option seller that he, even if the price goes to 1,000 or 1,200, he have to sell you the shares at 800. So you can buy the shares of Tesla, this is Tesla, at 800. Doesn't matter where the price is at that time. So it basically is good for it's good for buyers, just because if they know something, there's a news coming out which you shouldn't know. That's why there's a lot of dodgy things actually happen on the options actually, because like you'll see insiders will get paid in options or stuff like that. It's just because so that they can buy back the shares at the cheaper price if the stock has moved up like significantly, right? So in simple words, with calls, what calls means is you are betting the price can go higher. That's it. If you see a pattern forming on a chart, and you're like, it's a flag, so you want to buy calls right here. So when it goes higher, you can get paid. The premiums move higher a little bit, and we'll talk about why the premiums move higher. Okay. And the price has to go higher by the given date. So sometimes people, they swing their contracts. So you want to see the price actually move in the money. Let's say you have money to exercise the contracts, and that's why you bought the contracts in first place. So you really want to see that this 800 contracts lies in the money at the day of expiration so that you can exercise. Otherwise, it would just not make sense. If you can, in the market, you can buy for 750, why would you try to buy for 800? It doesn't make sense, right? So it's much better for you to buy 100 shares at 750 a share rather than paying 800 a share. So if it lands in the money and we're trading at 850, so it makes sense for the guy to actually buy 800 times 100 rather than buying 850 times 100. Does it make sense? So buyer always has a choice. Buyer will always have a choice to either exercise the contract or just let it expire worthless. So is another thing, doesn't matter if your contracts expire in the money at the day of expiration. It can be deep in the money, but you still have a choice if you want to exercise the contracts or just let it expire worthless. Okay. And I saw other day there was Max Rick, I think he was quite in a chat, he was very worried that his call expired in the money and he will get assigned. No, if you're a buyer, you don't need to worry about that. If you're a seller, then it's a worry. Okay. So let's say if you let it expire worthless, in this case, only loss would be the premium that he paid for the contract. So if you bought this at 1895, which is 1895 plus commissions, that would be like 1900, let's say for. So, and if you let it expire worthless, you cannot lose any more than 1900. So you already know what you stand to lose at first place. Okay. So now let's talk about put contracts. A contract that gives the buyer right to sell back the shares at a particular price, which was set at the day of agreement. So basically, you are betting the price to go lower. So lately, we've been seeing a lot of downtrend in the market, and we can see little patterns forming like this on hourly charts, and we break with some volume and we move lower. So this is like a perfect entry for us to get in puts, and so that we can ride the premiums higher and higher and make a lot of money. And stocks move up like this on a staircase, but they come down like this. So it's quite a lot of fun to trade the downside as well. Right? And this is definitely this is due by the given date. Like in the call contracts as well. So buyer always has a choice to either exercise the contract or just let it expire worthless. So being a buyer of the option contract, you really don't have all these worries about what if you get assigned. You are the boss because you are the buyer. You're the customer. You know how they say customers the king. So you, as a buyer, you always have a choice. You're the king. Okay. So if you let it expire worthless, same like call contract, only loss would be the premium that you paid for the contract. So if you got in at 26.10 and this is deep in the money, you do not have to exercise it. You can let it expire worthless, and only loss would be that $2,600 and nothing more. Okay. So strike prices. This is very important because I see a lot of people every single day, they pick up strikes which either very further out of the money, or they pick the strikes that have no volume or no option open interest, and they get stuck in a trade. Or even if the stock does move with them, let's say if they bought it $100 and the stock's gone up to 102, but because they bought a wrong contract, it doesn't have a lot of volume, and like this can be on Shopify, let's say 400, and you bought a wrong contract, the spread bids and ask is so wide, even if it moved with your favor, you'll still end up losing money because you just didn't choose the right contract. There's a little art behind this. It's not a science, it's just an art. If you learn once, you just have to figure out every single day in the morning, and it's quite easy actually. So what is strike price, by the way? So strike price is the specific price at which the underlying security can be bought or sold with an option contract. So if you do have to exercise and you bought 800 calls, so you can't go up there and be like, nah, it's trading at 750, let me buy 100 at 750. If you want to exercise the contract, you have to pay that 800. Okay. Same goes for the puts as well. If it's 755, you're gonna pay 755, nothing less and nothing more, right? If you do choose to exercise, otherwise you can just let it expire worthless. Strike price is also referred to as exercise price. So you'll see a lot of times on YouTube videos or anywhere else, you'll see people talking about strike prices, exercise price. So don't get confused. That means strike price. So expirations, like I spoke about before, like on zero DTE, it normally says zero days. On Thursday, it would say 1 day to expiration. Wednesday, 2 days. Right here on every single broker. I don't know much about Robinhood, and it's just, but on every other single broker, you'll see option chain like this, or a little bit different, but the basic idea would be this. And you'll see an expiration date on the top before you choose any contracts. You can see which expiration you want to pick. Okay. So expiration date is the last trading day that an option can be exercised. If the option buyer does not exercise the options, the option strike price is and option strike price is out of the money, the option will expire worthless. Okay. If the contract is in the money at expiration, okay, if the contracts are in the money at the expiration, an option writer does not buy back the contract before end of the trading day, the option will automatically be exercised and seller will be assigned. So what does that mean? So let's say you are an option writer. So you can basically go out there and sell a contract. You know how you buy a contract, buy a call. So what they do is they sell a call, right? And it's a zero DTE. And to close your trade, what you do, you sell your call, but this guy already has a call. So what he does is he buys back a call. Now, let's say if the contracts are in the money at the expiration and you being option writer, why I'm trying to explain a little bit of option writer stuff as well is because from here, you guys only going to go higher. If you're watching this right now, you're only going to go higher. Eventually, you're going to get where you want to go, right? And after a while, there's only so much size you can do on options or on stocks as a day trader. You can't go out there and try to buy $100,000 worth of contracts any given time because you can't basically scalp. So you can day trade, but if you want to do scalping, it's just too hard. And there's a lot of psychological factors that come with it as well. So you may look into further down your journey, you may look into option writing, where you can just write some calls further out of the money and collect the premiums. It is a good source of income. It's pretty consistent source of income. Eventually, you just like chill, and the money is just like coming in over and over, and you do over and over again. It's good. But if you're not good at it, you don't have to do it. You'd rather give the money to some big bank like Morgan Stanley or something. I think the cutoff is 500,000, 500,000, and they can manage your money because this is what I do. I don't do this stuff by myself because I'm a day trader. I'm not good at that stuff. So I have other people and they charge fee and other stuff, but eventually they definitely make more money than I do in the long term, on the long term account. If I'm doing it, it just I'm just not good at it. I don't know. I'm not good at it. I don't want to try something new right now where I am. I'm happy with whatever I make. I'm always happy to learn anything about day trading, but if you want me to learn about option writing, it's not something that I really do. But a lot of people I know who do option writing and they make a lot of money. So you can look into it by yourself. And if you do not buy back, like if you sold a call and you do not buy back by the end of the day, the option contract will be assigned to you, and then you will have to fulfill your obligation as option writer. Right. So let's talk about expiration cycles. What are expiration cycles? Expiration cycles determine when an option contract expires. The most common expiration cycles follow one of three cycles. It can be cycle 1 January, expires in Jan, April, July, October, basically the first month of each quarter. And then we have cycle 2, that's the second month of each quarter, that's called Feb cycle. And third one is March cycle, that's the third month of each quarter, expires in March, June, September, and December. And now you guys be like, why do I need to know this? If you want to go, long-term leaps and stuff, you really want to keep this in your mind and to choose monthly contracts rather than weekly contracts, so that you can make some money, not letting Theta affect you. There's some other ways, but option expiration for monthly contracts is always the third Friday of the expiration month. If the third Friday is a holiday, the expiration for monthly contracts is just on the third Thursday. Okay. And triple witching occurs on the third Friday of March, June, September, and December. And here's the effect. Since the day I have started trading, I had never made money on third Fridays of March, June, September, and December. It's so much job. This IV crazy. Option prices are moving crazy. And I just want to put this, that's why I wanted to put this in here. So you guys can, before you put the money in there that day, you can go back, do on-demand feature on your Thinkorswim. You can actually see what happens normally, how the option contracts move. That's why I actually wanted to throw this in there. Because what is triple witching? It is when stock options, so basically all the stocks like Apple and all the names like that, stock options, stock index future contracts, and the stock index option contracts expire on the same day once a quarter. So every 3 months they expire at the same day. And that's where that day it's quite hard to actually trade. And it's hard for me. I gotta admit this. It's really hard for me. I'm not one of those who just like are perfect. I have never made money on those days. And it's good to be aware of that stuff so that you can save yourself some money when you're doing next time. If I have to trade, I'll size down. So otherwise, I do not trade on these. Okay. So don't confuse yourself. This is all for your basic knowledge. Basically, options expire. This is a simple fact that because you all are here, I think you all want to be a day trader as of now where you're in your journey. So this point so basically options expire every Friday. Or if it's a holiday on Friday, it will expire Thursday. And on SPY, QQQ, SPX, all these, they expire Monday, Wednesday, Friday. On SPX, it's a little bit SPX a little bit crazy, but SPY, QQQ, Monday, Wednesday, and Friday. I'm pretty sure by SPX as well. I don't trade much of it. It's just so you guys need to know about all this expiration cycles. I think where you all are right now, this point is much more. I think you all liked, but you please keep this in your head as well. It's called triple witching day, and it's quite hard to trade sometimes. Okay, let's move to the next topic called option premium. So what is option premium? This is as you guys can see, this bid ask. So this is volume. It's clear. This is open interest. We'll talk about it soon. This is a Greek. Just leave this alone for a minute. So these are the premiums that you have to pay in order to buy a contract. So if you were to buy a 780 contract It can be even for day trading. It can be even for swing trading. It can be for scalping. So if you want to buy 780 gold, you have to pay this figure, and you can try getting fill at the mid. So mid is basically half of this. So the software will do it for you, so you don't have to worry about it, and you can place your order at the mid as well. But what I usually do is I always buy at the ask and I always sell at the bid. Why do I do it? It's because it makes your life quite easy. It just, let's say if Tesla broke and it made $30 move, and I tried to get filled at the mid price and I never got filled, and now I'm sitting there trying to chase. I'm not doing that. I'm quite serious about this. I don't really care. If I have a solid plan, I'll pay a few extra bucks for to hit the ask and to actually catch a move, because all you need is one good trade a week to be consistent. And on that good trade, and you still try to be a little tight ass, and you never jumped in a play because you never got filled, there's something that you need to worry about. Okay. So what are option premium? So option premium is the price of an option contract. Option buyers pay the option premium to the option sellers at a mutually agreed upon price in the open market. It's quite clear, I think. So if you are an option seller, you will get this money in your account. So what happens if you buy this at 27.75, which is 2775? So from your account, it gets deducted and it gets added to the guy who is selling you the option contract. So you make money if it goes to, let's say, 3200, where you sold at 32. If it goes there and you made 425, this is your profit. And he makes money when the option premium drops. Let's say price dropped, price went to 750, and this contracts are trading at $1,500 now. So he want to sell his he want to buy back his position so he can just enjoy the leftover money. So he already got credited 27.75. Now he have to buy it back, and he made 12.75 on that. So this is how the buyer and seller thing works. So if you're buying something and the money is basically going straight to the option seller at a mutually agreed price, whatever you paid, whatever the price, the bid and ask is in the open market. So an option contract premium is considered. An option contract premium is consideration given by the buyer to the seller to enter into a contract. So you are paying a little fee because seller is taking a huge risk. That's why they get paid beforehand, because they're taking a huge risk. And you need a margin account for that. You need a lot of money for that. Let's say if he gets assigned and the price goes higher and higher, and he have to sell his shares. So he's taking a hit of this price and whatever price he's trading at, let's say at 800. So he's taking a hit of 20K just because he's taking a big risk. And that's why so it's a little fee that the option rider gets to keep, option seller gets to keep, just for the risk that he's taking. So option buyer is paying a premium for the opportunity to call, buy, or put, sell shares of the stock. All right. Now, I'm going to give you guys some examples of call option. Okay. So now let's say right here, as we have right in front of us, on November 16th, Apple's trading at 151, right? you guys can see right here, right? We're trading at 151 right here. And so trader X working for K Capitals want to buy 100 shares of Apple on long-term account as he's anticipating a break of this flag. So this trader X, he thinks we can break this flag. We have 2, 3, 4 touches. And if we break this flag, we can move to the all-time highs and even further. But there's a risk involved, right? But now he wants to control his downside, as Apple can also reject right here and go downwards. So like in real time, you just don't know the price just gonna break, or it's just gonna go like break a little bit, false breakout, and just keep going lower and lower, right? Not that much, but it can go lower, right? So there's some risk involved, and he do not want to take the risk as such, or with his big position as he's buying for some long term. So what he does is, so he buys 1 month out contracts for December 13th at a strike price of 155, because he's thinking if the price breaks the high of the day, high all-time highs, which is 157.26, and he have 155, if the price is above it, so he can exercise them right here and make some money. That's just where he's trying to control his downside. So now this trader X bought the call options expiring 13th of December for, I'm from Australia, so please ignore the way I'm writing dates. 13th of December for $5.10 premium. So how much money did he pay? So he paid $5.10. Every option contract can control 100 shares. That's why it's always get multiplied by 100. So he's paying $510 plus, let's say there's $5 commissions, or just I could take the commissions out for now, right? So he paid $510. Okay. So now trader X gets the right to purchase 100 shares of Apple at the price of 155 by December 13th, 2021. So he can literally go right now. There's 2 different types of options. One is the US option, and the other one from Europe. So in Europe, you have to wait for the expiration date. But for US, you really do not have to wait for the expiration date. You can just exercise them at any time. Like you can buy them and you can exercise them straight away. Okay. So don't confuse yourself. We only trade US. I just threw it in there so you guys know. So, okay, next point would be, so if stock fell to 140, so we're looking at this number right here. If stock fell here, what would be the trader X loss? The only loss that he is going to take is $510. He will not lose any more money than 510, even if price fell below this, or even if it stays here or whatever. He only money that he can lose is that $510. Okay. But if the stock goes to 165, he can buy back his share. He can buy his shares at 155 from the options, and he can profit $10 a share straight away. All right. Now let's see what actually happened if we would have taken this trade. This is exactly what happened, mate. So as you can see on the right, the day of his expiration, Apple was trading at 179.45 a share. Okay, this is the day of his expiration. Apple's trading literally $30 above is where he entered. So it would make sense for trader X to exercise his call options as the price is trading above his strike price. So his cost, basically how much money is he paying, do you have to pay money to exercise contracts. So that means 155 times 100. So he's paying $15,500 and he's buying 100 shares at 155 level. Okay. So he got 100 at the 155, he owns 100 shares now. But the market price of those shares now is 179.45. That's the current price. Times 100, that's 17,945. And his total profit is 17,945 minus 15,500, which is $2,445. But now there would be another charge here. I was just trying to make it a little easier for you guys to understand. There will also be a cost of his premiums that he paid initially that will be taken out of this number as well. Okay, so his total, his profit would still be like 1,800, 1,900 something, but that is his loss as well, because even though contracts expire in the money, that was a fee that he paid to the seller. Not it doesn't belong nowhere in the market. That's a fee that's going to the seller. Okay, it's so he still have to pay the fee even if he exercised the contracts. So that's another loss for him, $510, but he still profit around 2,000. All right. So let's talk about put option examples. So Apple on March 30th, 2021 is trading at 177.77. And let's say there is a bad news about the stock, right? I don't know if it was actually, I didn't actually go back to check. This is 2022 here, typo, right? So let's say this is trading at 177.77 and there's a bad news about the stock, and trader X working for K Capitals want to short 100 shares of Apple as he's anticipating a drop in the price because of the bad news. He's thinking it can affect the valuation of the company and we can drop. So he wants to short 100 shares. But now he wants to control his downside as Apple can keep going higher. You know, if you short shares, basically to the downside, we always have zero. On the bottom, we always have zero of the chart. I've never seen a stock go in minus. Okay, it's just not possible. They go bankrupt. But on to the upside, it goes to the infinity. The numbers go to the infinity, and you guys should be aware of what happened to GME. So if you short a share, you are risking a lot. It can basically just make you broke. Not on Apple so much because it doesn't make crazy moves, but that is just in general. Okay, there's a big risk involved in shorting any names, and you need a margin account for that as well. So he buys 1.5 month out contracts for May 13th, 2022, strike price of 165. Okay, so now let's see. So he's expecting the prices to go down to 165. So if the strikes went below, if the option prices went below, stock prices went below 165, so he can make some money. But if it goes higher, he can't lose any more than what he paid for initially, right? So now this trader export the put option expiring on May 13th for 480 premium. So how much money did he pay? He paid $480, right? So now trader X gets the right to sell 100 shares of Apple at price of 165 by May 13th, 2022. So he has a right, like he has a choice now. So he can sell 100 shares of Apple if the price go even below 165. He can short at 165. Okay, but if the stock goes to 200, his only loss is that $480 that he actually paid for. So he can't lose any more money than he paid in option premium. If the stock goes to 150 now, he can sell shares at 165 and buy them back at 150, which will give him a profit of $15 per share. So this is what he's expecting it to go to, but prices actually went to 150. So that means he can sell shares here and buy them back here, and he will make $15 a share if it did if it does go down below 150. Okay, so this is what happened. As you see on your right, the day of his expiration, Apple was trading at 142.56 a share. Okay, so it would make sense for trader X to exercise his put option as the price is trading below his strike price, which was somewhere here at the cost of 165 times 100. That's he's paying. He's basically, you guys understand what I'm saying. I'm trying to make it super easy here, right, for you, right? And now, but the market value of the share is 142.56, which is like 14,246, 256. So the total profit, if he sells his shares at the top and buys them back again at the bottom, so the profit that he can make is quite enormous. So that's another 2,200 minus the premiums that he paid, 480, which will make him like 17 something, 18 something, 1,700 something profit he will still make. Okay, now let's see the show of hands for the people who actually understood this so far. Okay, perfect. Now, I'm going to make it super easy for you guys now. Now it will be super easy because I'm going to give you guys an example which you will never forget for your life. And this is an everyday example that we all use in our real life, right? Now, boom. Really simple for you guys. I'm a no BS guy and I like to keep things very simple so everyone understands. So let's say, just think of coupons, right? And this is really why it's not complicated, because we use options basically everywhere that we go today. It's just how you look at it. Here's a really stupid coupon for hot dogs, right? So it's saying now I'll go back 1 point, and now it says hot dog only for $7. So what is $7 right now? What's $7 right here? $7 is the strike price. Okay, $7 is the strike price right now. Okay, and let's say Kate bought these coupons from the restaurant for 50 cents. So 50 cents is the premium he paid. All right. And $7 is the strike price. And December 25th is the expiration. So what is this? This is basically call option on hot dog. Now, this coupon's a little bit old, so but be with me so you guys understand. So this says hot dog for basically $7. That's a strike price, and that $7 we already have in there as far as the price that we have determined, right? So this is the strike price. We have expiration date right here, and there's a premium paid 50 cents. So now let's say he, goes to the restaurant, and on the board he sees special hot dogs for $3. So what do you think makes sense for K to actually do right now? Should he still exercise his calls, or should he just go and buy it cheaper? Why would he pay $7 if he can buy the same thing for $3, right? So in that case, he will let this expire worthless. He's like, I don't care. I'm getting it cheaper anyway. Why would I care, right? And but now on the other side, let's say if he goes to a restaurant, on the board it says hot dogs $12. So he's like, oh, sheesh, I'm very hungry. I can't pay $12. I have seven. He goes to the cashier. He's like, look, I have this. And she's like, okay, sweet. And she charges him $7. So he saves himself that $5. 12 minus 7. Also, he already paid 50 cents initially. So he saved himself $4.50. So this example would actually make it very, very simple why you shouldn't exercise the contract if you're getting it cheaper in the market, and why and when you should exercise the contracts when the name is dear, when the stock price is dear, and you have the contract for cheaper price, so you can just buy at $7 instead of 12. Okay. I hope this makes sense, because I tried to make very, very simple for you guys. So let's review again. So just so we really understand this entire concept, let's just review the main basics before we jump into some more further details. So let's see if you all know this stuff by now already or not. So what is call options? So in call options, you buy a stock at a fixed price at a future date. For puts, you sell a stock at a fixed price at a future date. Okay. And that's basically everything that we have learned so far. Now, how to read a stock option quote. Okay, now why do you need this? When do you use this? It's mostly used in when you have to read the flows, or the golden sweeps, or it can be big unusual orders, split sweeps. When they come, they are normally in this quote, and sometimes people make a lot of mistakes trying to understand what it actually is telling us, and they get confused. And you also see quotes on your brokers when you try to look at the charts of the option. There's a weird number written like a code word 360 C blah 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 blah. that is how that is an option code. And now we will go dig deep into this and we'll actually understand what this code means. Okay, and how to read it. So options based on equities, more commonly known as stock options, typically are natural lead for traders new to options, right? Stock options are listed on exchanges like the New York Stock Exchange in form of a code. It is important to understand the detail of stock option code before you make a move. It's very important, just like the basics that if you want to drive a car, you want to know where's the race and where's the brake. You can't be going in there and you'll figure out the real market. No, instead of pressing brakes, you'll press the race and you're going to hit somebody, right? So you have to know this stuff before you start putting money in the real markets. Okay, so there are 5 parts of a standard option code. So they're just 5 parts, and it's very, very simple. It's very easy. I'm gonna really make it look very, very simple for you guys. Stock symbol refers to what's used to identify the underlying asset attached to an option contract. So the first one would be the stock symbol. It can be, let's say, Apple. That's it, just to identify. All right. And then we have expiration date, what day the option will expire. Then we have strike price. What strike price is this option code about, right? Then it is either it's a call or a put. And the last one would be premium is the cost to buy the option contract itself. And it looks like this. So this is actually a screenshot taken out of my book. You guys can see the back. So XYZ is the stock symbol. It can be Apple, December 17th, 2011. That's your expiration. Then you have 70, that's a strike price. Then you have call or put. It can be just C or P as well. Doesn't have to be the whole thing. Call or put. What's the premium paid for it? 310. Right, this is very, very simple. Make your life really easy here. Don't worry, let me make it easy for you. You might be like, damn, what the hell is this guy on about? Don't worry. I was the same when I was learning about them. So I remember when I was learning, I think I was like, nah, I think I stopped learning options when it started getting a little bit harder. I was just like, nah, I can't educate myself. I'll stick to shares. But I think that was one of the biggest and most successful decisions that I made to actually switch to options. But let me break it down for you guys, and you will be able to understand this fully by end of the next slide. Okay, the option code, so you'll be able to understand the end of the next slide. So this is your thing that you saw on the previous slide, and A is the stock that the option is based on. It's usually representing 100 shares. Okay, whatever the name over there is, because we have a decimal here, that it's just saying that we have this code means 100 shares. If it says just one contract, that means 100 shares. All right, that's A. B is that's the day of the option expires. The last day to trade this option is usually the Friday of every week on stocks. So the last day to trade the same week expiration is Fridays, or if you're doing SPY queues, you can trade Monday and Wednesday as well, option expirations as well. But the last day is always the day the option expires. That's a strike price. See right here, the 70 bucks. That's a strike price for the stock. The stock will change hands at 70 if the option is exercised. So if the price is trading at 75 and you, the option buyer, you want to exercise, you don't care about 75. The stock, you will get your shares, 100 shares at $70. Doesn't matter what it's trading at right now. Okay. So this D right here is the type of option. So there are two types of options, calls and puts. Okay. And the last is premiums or per share cost of the option. This is like, what would you pay for one option contract? $3.10, or it's also called premium. And this is the cost of option. To actually open the contract, you have to pay that. So option contracts usually represent 100 shares of the underlying stock. So you will actually pay $310 plus commissions for this contract. So it can be 310 times 100 plus is 310 plus, say, I think it's 80 cents on IBKR. Depends on your volume. So it's 310.8 is your cost to buy that. Okay. Don't forget to like the video and subscribe to the channel. Keep learning, champion. In the money, at the money, out of the money. So there are three different types of strike prices. This is all, we're going deep into strike prices right now. There are three different types. First is in the money, then we have at the money, and then we have out of the money. And I'll also show you on the option chain once again, just to refresh everything. So all this up until one strike towards the blue this is all out of the money. This is out of the money, right? And this all is out of the money as well. So this side's usually puts for every stock, and so this is out of the money. This size is usually calls for every single broker. Okay, and this right here, I'll change the color. This right here is in the money, and this the whole blue thing is in the money. Contracts are usually expensive when they are in the money because they have got the intrinsic value, which we will talk about in the coming slides. This is all in the money. So this is one strike that mostly all the day traders love. Right here, this. Yeah. So this is at the money. So normally, usually you will see, because this is aftermarket and the spreads are a little bit wide, but usually you will see at the money and almost at the same price. The strike price is always kind of the same, just because the spreads a little bit and just a little bit funny. But the first contract after in the money is called at the money. ATM. Okay, so this is just to give you guys an overview. So what we're going to talk about, and it's out the way. Let's see. So in the money contract, so a call option holder that is in the money at the expiration has a chance to make a profit if the market price is above the strike price. So what I mean by that is, so if you're a call option holder, if you bought a call option and you bought a 140 call option on Monday, and right, this is, let's say, last Fridays, and this is Mondays, and it expired here. So guess what? So the guy who sold you the options have to sell you shares at 140, and doesn't matter what the price is right now. So you still get the shares at 140 because you bought 140 contracts and you exercised it. So you basically straight away you made $10 a share just by exercising the contracts. Now, how would you profit from this? Is so you buy, so so he gives you the shares, so you buy shares at 140, but the market price at that given time is 150. So you can sell at the market after hours or whatever, when you exercise the contracts, or even during the market. So he still have to give you, so you still make $10 an hour, $10 on an option contract. Okay. So this is basics of how you make money in the money. The contracts are usually very expensive because of the intrinsic value. So an investor holding an in the money put option has the chance to earn a profit if the market price is below the strike price. So exactly what I explained before, and I gave you an example as well. Exactly the same thing. Just on the opposite side. And so investors must also consider premiums and commissions expenses to determine profitability from and in the money options. Okay, like I told you guys before as well. So if you made $1,000, but the options costed you $14 for your, let's say $14, that was the commissions, and the options costed you $320, and so you are making a profit. You're still making a profit, but these are expenses which will be getting deducted from this, and the leftover would be your total profit. Okay. So in the money options are more expensive than the other options since the investors pay for the profit already associated with the contract, right? Let's say it's Friday and you buy in the money at $140, the strike price of 140. So guess what? As I said there as well, they are expensive because you are already, if you decide to exercise, you already have a profit of nearly $1,000. So that's why they're usually very expensive, because they already hold that profit that they're carrying with them at that given time. Okay, let's talk about at the money contract. A call put option is considered and at the money when strike price and stock price trade at the same time. At the same price, I think. Oh yeah, you guys understood. A bit of tongue twister. But so here's the thing now. If a stock is trading at 152.5 or a little bit below this, the first one would always be at the money out of your different color one, just to keep it super simple for you. And if you are using one of the brokers that are just that doesn't have a good option chain, you need to switch your brokers so you can, avoid all the confusion, make your life super easy. Okay. Um, so my favorite, as from my experience, at the money are my favorite. They are the best for scalpers, they're best for day traders because premiums prices increases as soon as we move in the money because we are trading so close in the money. And if we're looking at gold and the stock prices go higher, if we are in this and the stock prices go higher above 152.5, and this becomes you're in the money now, and this becomes at the money, this is in the money now, what happens is that you straight away start getting in, the intrinsic value start adding up to your contracts, and it pays quite well. So I love trading at the money contracts. Okay, now let's talk about out of the money contract. So out of the money contract, also called OTM, meaning an option has no intrinsic value, only extrinsic value. Extrinsic value, so intrinsic value basically means is, how do you say it? So that's the value of the option that the profit the options are carrying already. The profits from the option that they're already carrying, they have a little value for the person who buys them. They're already providing something. But extrinsic value is something that's basically not providing anything other than hope. So extrinsic value is also called time value. That's why when we move further out of the option chain, we see premiums really expensive. That's just because of the extrinsic value. I'm going to be honest with you guys. The intrinsic value stays the same on, doesn't matter what, it does not matter what weekly, either it's a weekly expiration or it is 2 years out, the intrinsic value of that same strike price would be the same. It's always the extrinsic value, which is always fluctuating based on IV and other stuff. But I will dig deep into this. It's just to confuse you guys a little bit. I don't know why I started talking about it. But out of the money is they only have extrinsic value. So a call option is out of the money if the underlying price is trading below the strike price of the call. Right here. So this would be out of the money. So if you have 160 calls and the price is trading below 160, right? So that is, if the price is trading below 160, and this is your, so that means this is out of the money, and we like to trade at the money. Okay, that's where the money moves. So a put option contract out of the money is the underlying price is above the put strike price. Okay. OTM options are less expensive than in the money or at the money options. This is because in the money options have an intrinsic value and ATM options are very close to having intrinsic value. And, I do not think that anybody should trade out of the money contracts unless it is Amazon or Tesla and we have a lot of volume out of the money rather than at the money, then it's fine. And if you are looking at AMD and you know something, or you have done your homework and you think if this level breaks, we can make a $5 move, then it's a good idea sometimes to get out of the money calls and you hold it basically as a day trade. And, you get the gamma squeeze, which we will talk at the end of the session, where we're looking at gamma squeeze, or you're looking at some other factors where you can make some extra cash. So now let's talk about when can you trade options. This is another question, because a lot of people ask. I saw a lot of people ask me in my personal messages that they are holding their options, and when can they sell them. And it just blows my mind that you're putting your money in something and you don't know what the ins and outs of that. And that was a big reason why I wanted to push this a little bit. It took me quite a while to make the slides, but I wanted to push this a little bit so that all these people can stop losing money. All right. Because it's sad that they just listen to someone or see someone's flash car or something, and they just want to do the same thing. I mean, do not compare your chapter 1 with someone's chapter 10. It never ends up well. Options can only be traded from 9:30 a.m. when the market opens to 4 p.m. when the market closed. Okay, you cannot buy options after the market close. Okay, you cannot buy options, you cannot sell options, you cannot buy them in the pre-market. The only time that you can buy is between 9:30 to 4 p.m. Eastern time. Okay, you can exercise your contracts after the market close for like an hour. I only exercised so far like maybe twice, maybe once. That was just because I forgot to actually close and I was in the money, and I didn't knew that I was in the money, and then saw a notification. I'm like, oh nah, I'm not taking a loss. I'm just going to exercise and sell and make some profit. So you can exercise your contracts after the market close. I think they give you like 45 minutes, or depends on the broker as well, maybe an hour. Depends on the broker as well. Okay, now the most important topic out of the whole thing that we're going to talk about is option pricing. How the options priced. One of the one of the most important why options actually move in prices, or how to set stop losses. This all kind of lands in this thing, option pricing. And so an option price or value is determined by the price of option underlying asset in term of option contract. The price of option contract is also called option premium, right? The underlying securities price, the option strike price, the remaining price until expiration, the underlying securities volatility, the current risk-free interest rate, and the dividend rate of the underlying security are all considered in determining an option contract's price. So here was a thing. I bet a lot of people didn't knew about this. So the underlying strike price, what strike you have, option strike price, underlying security price, strike price, how much time you have until expiration, what's the IV, what's the risk, the interest rate, or what's the dividend rate of the underlying security. This all forms up premium. So all these things go together and forms our premium. Okay, and then so premiums have two further parts in them. So number one is intrinsic value plus extrinsic value. So every single premium have intrinsic value plus extrinsic value. Every single strike price will have them. Not so much extrinsic when you're in the money, but you will always see a little bit still there. And intrinsic value is trade pretty much. Extrinsic value is time value plus implied volatility plus dividends plus interest rate, quite a lot of things as well. Okay, so don't get confused here. We will dig deep into intrinsic and extrinsic value in the upcoming slides. So what is intrinsic and extrinsic value? So an option premium is made up of two things: intrinsic and extrinsic value, right? And intrinsic value is reflective of the actual value of the strike price versus the current market price. Now, I know a lot of people be confused. Let me pull up my option chain and actually explain. So what would be, like, let's say 150 is the, let's say this closing price, we change it to 150 to make our life easy. What is the intrinsic value of 140 calls? That is strike price minus, closing price minus strike price. That is $10 is the intrinsic value. Okay. And if we are doing puts, here's a little bit something different. If for the puts, you have, let's say, 160 puts, and right now the price was trading at 150. So here you have to, over here on the call side, you would pick closing price minus strike price for intrinsic value, but here you will pick strike price minus closing price to pick your intrinsic value, right? So here in this case would be 160 minus 150, which would be $10 as well. Okay, this is just the basics of intrinsic value. Is a reflective of actual value of the strike price versus the current market price. Extrinsic value is made up of time until expiration. As I said, there's quite a few things that go in the extrinsic value. You have how much time you have till expiration. Then you have what's the IV. Then you have dividends. Then you have interest rates. So this thing doesn't happen very often. Like, how often do you they go, okay, we're going to change the interest rates again, but they don't do that often, right? They don't change dividends on the stocks every single day. So this is not that often, but we still have to be aware of them. Every now and then, every month, every couple of months, just have a look. But this is what matters. If you're doing this week expiration, the extrinsic value would be, the gamma would be crazy, which we'll talk about. So we need to know about what's the time till expiration and what's the IV. Okay. So now, I'm pretty sure you guys understood so far. What is option premium? Intrinsic value plus extrinsic value makes option premium. Okay. Let's take a deep dive into this topic now. Intrinsic value of options. I want to show you one thing before I actually go further into this. So let's say this, right? Pick up 140 and closing price is 150, as we can all see, close a little bit above 150, but let's say 150, right? So what's the intrinsic value? 150 minus 140, that's $10, right? But the premiums are trading at 1135 and 1170. What it means, let's say we round the number off to 1150 minus $10. That's the intrinsic value of the original premium minus this. We will be left with extrinsic value of $1.50. That means that's a time value of the name. So the options are only holding $10 worth of stuff, but $1.50 is what we're paying for our extrinsic value. And in every single name, you will see this. Doesn't matter what name it is, this is something that on every single strike price you'll see. Okay. So intrinsic value of options. It is one of the most important concepts that you need to grasp as an options trader. It's really important. You have to know the internals of options, and these are the basic internals of all the option contracts, right? Intrinsic value is the difference between the current price of an asset and the strike price of the option. Like I explained to you guys before, very simple. Look at what strike you have bought and what's the price trading at the moment, right? Intrinsic value is only for options that are in the money. You cannot be looking at premiums here for intrinsic value, because you will be left with disappointment and not intrinsic value. There's no intrinsic value over there. All right. At the money and out of the money always carry no intrinsic value, like absolute zero, right? Intrinsic value is gained only when the contracts are exercised. So you can't go out there and you can't be like, all right, you can only gain that. That means, the $10 that we determined before. Remember this $10 that we determined before? You can only, when you exercise your contracts, then you can gain those $10 a share on the shares you were holding. Okay, otherwise that intrinsic value would not have any significance if you do not exercise. Intrinsic value of the same strike price do not change for any expiration. Am I making sense? Intrinsic value do not change for the same strike price for any expirations. You can go, 2 years out from now. You can go 1.5 years out from now. There would be the intrinsic value of the contract would be exactly the same. The only thing that will keep changing is the time value from extrinsic value, right? So now I explained a little bit further here how to actually calculate the intrinsic value of calls and options. So if this is the closing price and this is where you land at, like right here, we can see this is the closing price. This is the contracts we have. That means 335 is the intrinsic value, and the leftover $1.50 or $2 is our extrinsic price. Okay. Same goes for extrinsic value, and same goes for the puts. So these contracts right here, the intrinsic value is 265 as we calculated, but they're trading at 425, which is $1.50 or $1.60 more. That's $160 more. That means 160 is our extrinsic value. Okay, so we all learned what's intrinsic value, where is intrinsic value normally at, how to calculate it, how to like everything we have learned on call side, put side, you guys know now. Okay, so extrinsic value of options. Extrinsic value is also called as time value. Just simple because you are buying contracts out of the money. You have contracts out of the money, and you're hoping the price will go there, and you will go back. You will land in the money, and so you're basically paying for the time where you're sitting and hope is where the time value you pay for just to enjoy the time where you are in, and in case you go in the money so you can make the profit. Okay, it's one of the most important concepts, as I said, for intrinsic as well. Extrinsic value is for all the options regardless in the money, at the money, or out of the money. We will have time value, doesn't matter what strike price we are choosing, we will have extrinsic value on any expiration, any strike price. There will always be extrinsic value. So change in volatility, change in implied volatility, we will discuss in coming slides in detail, can influence extrinsic value a lot. Have you guys ever wondered, or let me show you guys. Let's say Apple's trading at somewhere 150. What other names trading at? Let's see what GME is trading at, and just check the IV 32%, right? Let's see what's GME trading at. You see, it's cheaper than Apple, but we have IV trading at 148.5, right? Because the IV is so high, and that's why the premiums right here at the money, just check the premiums. At the money premiums are at $17.10, right? And that's at the money. And now we'll go back to Apple. And it's a bit expensive than this, and at the money premiums are sitting at 335. It's just because the IV is very high of that name. So IV definitely influences extrinsic value of the options. Okay. If we are going further out on expiration, if we are going further out, let's say you want to go down September 16th, 2022, at the money contract, they still hold same intrinsic value, but they're a bit expensive, as you guys can see. We can go even further, like this is 601 days from now. You see how expensive? They have the same intrinsic value. Only difference that we have right now is because we're adding some time to it. That's why it's getting expensive and expensive. So, okay. Okay. Now let's go further. Let's let's dig way deeper into options. Like this is where the game starts. Okay. Now, how many types of volatility is there? There's two different types of volatility. One is historical volatility, and the other one is implied volatility. Don't get confused. Don't get confused. I'll really make it very simple for you guys in the upcoming slides, and it's one of the easiest concepts. But so just remember the two type of volatilities: historical and implied. So, what is historical volatility first? Historical volatility is a measurement of the actual observed volatility of a specific stock over a given period of time in the past, such as a month, quarter, or a year. Normally, we day traders, we look at it over a year, but historical volatility is just, how the past IV have been on the name. This is basically it. If the stock's trading like this, how's the past IV? Like we can easily see if we look at the historical volatility chart, imply, the charts, we can see around the premium, around the earnings, the IV goes up as after the earnings we have a little drop, and then we go back a little bit and then have a little drop. Or for the next earning, we like same thing. Every earnings, that's why IV is always pushed up. We don't use this on a daily basis, so don't just be like scratching your head and be like, oh man, I can't trade options now because there's so much to do. This stuff is not, historical volatility is not something that we use on daily basis. So historical volatility for Tesla is way different to historical volatility of JP Morgan, as the range of both the stocks are very different. So this is Tesla, right? And this is JP Morgan, right? So everything is different about these two names, but once they started at the same price back in the day, a few years ago, a couple of years ago, 3 years ago, they were almost at the same price, but the IV will have been crazy for, this is Tesla's and this is basically for JP Morgan. So it's different for every single name. Okay. So this is all about historical volatility. Don't confuse yourself. Just know that everything gets plotted on the charts. You can just ask your broker or a charting platform to show you historical volatility, and it will plot it out for you, just like how volume is. Okay. Implied volatility introduction. Okay. So in financial markets, we all understand volatility as something very unstable and very bad. People hate volatility. It's just the way it is. Investors hate the volatility, and for us day traders, we look for opportunities in this because we love volatility, because that's where a lot of money comes from. That's why we do not trade JP Morgan every day, and we trade Tesla because there's some volatility on it, right? But people out there, they are people who, they think volatility is one of the worst things that can happen to your market. In the case of equities, stocks that have volatile earnings tend to get low PE valuations. That is price to equity, I think. Price to earnings, price and earnings, I think. I'm not if I can. I told you guys I'm not a long-term investor. I have no idea about what's PE ratio, what's this. I don't need to do that stuff. I'm so happy. But yeah, in the case of equities, stocks that have volatile earnings tend to get low PE valuations in the market. Okay. I know if it's below 15, it's a good name. If it's over 15, it's something overvalued. But interestingly, the situation is exactly opposite concerning options. Like for stocks, it's pretty bad, right? But we option traders, we learning options. It's very exactly on the flip side. Okay. In case of options, the higher is the volatility, the better it is for the value of call and put options, right? But a lot of us do wonder about implied volatility. Implied volatility, meaning or IV, as they, it's one of the, like, we just can't understand. Like, there's a lot of people out there who just can't understand IV, right? IV is unique to options, and we will look at that in detail later, right? First, let us understand what is implied volatility in general, and then we will try to learn what is implied volatility in options. But what is implied volatility in general? Like, what is implied volatility? So implied volatility is the expected price movement in a security over a period of time. Implied volatility is expected price movement in a security over a period of time, just as simple. So that means if the IV is at 30% of this, now, I think my monthly contracts were first open. Anyway, you guys see, if the IV of if it's 30%, that means they have already priced in that 30% move on Apple can occur, and they can still, they have priced in the option premium contracts. So it's already priced in, and it's just an indication to tell you that they're expecting 30% movement in the security, right? Implied volatility. Oh man, it's such a tongue twister. IV is forward looking and represents the expected volatility in the future. IV estimates the potential range for a defined time period. So on what was it, GME, it's 145% because of the recent past from last year of GME. The IV have been around somewhere here, like, since then. It's just because they are, they're protecting the downside and already pricing in this IV implied volatility in case. So they're expecting the price to move 145% in a week. But I'll explain to you guys, how many times does it actually happen when they're expecting something, and how many times it just fails. So option traders reference several different type of volatility: implied volatility, historical volatility, realized volatility, implied volatility rank, implied volatility percentile are most common terms um, in option trading, right? Historical volatility and the realized volatility are the same. IV rank defines where current implied volatility is compared to the IV over the past year. So that's just giving you a rank, like, are we high? Are we low in volatility? Like, what's going on here, right? For example, a security with the implied volatility between 20 and 40 over the past year has a current reading of 30, right? The security IV rank is 50 because IV is at the midpoint of the past year's range. So the rank goes from 0 to 100. So if it's towards 100, that means it's going crazy. If it's towards 0, that means it's going low from the previous year's range. Because now IV is somewhere in the middle in this example, that's why the IV rank is 50, because we are literally in the middle, right? But IV rank is not something that you really need. It's good to know this stuff as well. The IV percentile describes the percentage of the days in the past year when the implied volatility was below the current level. You see, if the IV, let's say an IV percentile of 60 means the 60% of the time IV was below the current level over the past year. You guys understood so far, I guess. Okay. While there are a lot of terms to consider, you don't need a degree in financial engineering to understand implied volatility. It's easy. Don't confuse yourself. Up until here, I know it could be a little bit confusing, but just something that we have to be aware of. If the IV is super crazy, there's no high IV or low IV. Okay, there's no thing called is a high IV very high. So on GME, this is normal. This is normal 120, 130, 140. This is a normal IV now, right? Um, and if on Apple, if it's 100% IV, then there's like, oh my God, why is that 100%? You know, but on Apple, normally it's like 30%, 40%. That's a normal IV on Apple when we don't have earnings anywhere nearby. So it's not, there's no thing called what's a great IV, what's a low IV. It's just something you're gonna look on the historical IV, or you can check IV rank, or you can check IV percentile. That how is the IV has the IV been over the past year, so you know a basic idea. If Apple's trading at 40% IV, you know it's a little bit higher than the usual. Normally we are trading at 30% IV. So you know there's something that you're missing, there's a news, so the market makers are already expecting something from Apple. So there can be news coming out, there can be something, so the market makers are already ready for it. So they're already making you pay a little bit extra for the premiums. Okay, that's IV. It's just basic. It's just like, so I actually made this. I think I did a good job. K price is $100. This is, for example, let's say K is trading $100 and IV of options is 30%. Okay, so the market makers think there's a 60% chances at the end of the year that K will wind up somewhere between 130 and 70. So they're expecting a 30% move. They're expecting a 30% move. It can be on either direction. It can be plus 30 or it can be minus 30. They're expecting a $30 move. That means the price can trade between $70 to $130, right? And there's always standard deviations is 68%. So it basically tops at the over here and it's 68%. So this is just a term. This is just a term. Don't add me why is it a term. It's just some things that you just do. And 68% standard deviation moves. But here's the thing. Now there's still a 32% chances, man. There's still a 32% chances that the stock will be outside this range. You see what I'm saying? There's always 68% chances in the middle, but there's still 38% chances from here and here. 32% chances, 16 and 16, 32% chances the stock will actually be outside the range. That means 16% chances we have the stock will go above 130, and there's 16% chances the stock will be below 70. Okay. Now you guys are gonna be, now you would be like, why are you telling us this? I am telling you guys this because I have a next example which will make life very, very easy for you guys in understanding this stuff. So this doesn't always mean that this is gonna happen. Why? I'll talk in the next slide. And I got one more point. Just remember, IV is based on general consensus in the marketplace. It's not and something that it's not something that's like a prediction or something. Nobody has a crystal ball, right? Stock can do whatever the company, if it's changing any market valuation, somehow they're coming out with something. Stock can go even higher. You can even just go bankrupt, like what happened to a few companies in COVID, right? After all, it's not as Nostradamus works down on the trading floor. It's just like it's just they haven't got a crystal ball. If they say it's 30% IV, it doesn't mean they always have to make a move bigger than 30 or less than 30. To the downside, upside, it can be in the middle, but it can be anywhere. But here's the thing now. Let's talk about in the next slide. And this is GME right now. Okay. Now, what does this mean? GME trading $100. K is price is trading $100, right? And the IV is 130%, right? That means 130% of 100. That is, you're looking at plus or minus 130. You reckon from here this can happen. From 100 to 230, it can happen. But to the downside, we can't go below zero. There's no way in the world we can go below zero, right? But they're still expecting 130% move. But it's trading 100. We can't make move below zero. And on further, they also see price go even further 16% below minus 30. So, that's why high IV doesn't always mean that you're just going to go out there and, it's perfect prediction. It's not always a good prediction, right? So the marketplace thinks there's 68% chance at the end of 1 year the K will wind up somewhere between 230 or zero. Okay, but there is still 32% chances the stock will be outside this range. 16% chances above 230, 16% chances below zero, which can't happen. Okay, that's what I mean when I say this is not a metric to know what's going to happen. You guys understand my point, right? So now there's a lot of things that actually impacts IV. But let's talk about what actually impacts IV. What changes IV? Like, why do IV go up and down like a seesaw, literally? So there's a lot of things that IV gets influenced upon. So number one, we would say is implied volatility gets impacted on when the markets begin to fluctuate, like we saw when market starts moving a little bit crazier. So the IV changes a little bit further too, right? IV changes a little bit extra, right? Then we have when we have like earnings coming up. How many times have you guys seen when we have earnings and the IV is going crazy? IV is like 90%, 100%, somewhere there, right? So we have to be careful around there as well because premiums are super dangerous right now. Upgrades or downgrades? There will be an upgrade from, let's say, JP Morgan upgraded or Bank of America upgraded a stock. And then we saw a lot of pre-market action, and what that does to a stock is the IV goes high on the name because the market makers are not sure how much the stock going to move. So they're protecting their downside by pushing the IV up. And with the IV, just the IV pushes up and a lot of people start buying or, a lot of activity start happening on the stock. Can also be news events like Twitter, on Elon Musk and Twitter, they're trying to do a deal. IV went crazy. I think IV was like over 100% that day. And then rumors, when the actual rumors started that he's going to buy Twitter, IV was going crazy as well, right? So, and it can be product launches. I remember when Sony actually came out with the, what was it, PS5. I think it was PS5. Um, and I was looking at the charts and options, and the premiums were like crazy, like it was super high. Um, it was just because, but here's the thing: the stock dropped after that. People got like there's some people I know who got like really crushed in that. But product launches, IV is crazy because people do not know what to expect from the name, right? And then we have interest rates. Like even now, like with everything going on, and they're trying to change some stuff up. IV has gone up. The VIX had gone up last few weeks, right? Because there's so much uncertainty that they have to protect the option sellers, have to protect their downside. And then we have dividends. So dividends that, like Apple pay dividends, Coca-Cola pay dividends, this all stuff influences IV as well. And then we have is expiration date, right? If let's say you go further and further out of the money, the IV is usually a little bit higher than what's right now. We'll show you right here. Right now, you can see we only have 29% IV, and now we will go down to say June. You see IV is a little bit higher, but this is Apple. Apple don't move hard, just 2%. But Apple don't move how it normally, we'll talk about it. Let's see about Tesla. So we'll add weeklies and we'll see how's this going. So you see we have 56% IV on Tesla this week. And if we go like a lot out, we have 62%. They are expecting the stock price to move that much in the meantime, right? Every week the IV would be different. Like this week we were 56, next week is 61, then 64. IV changes with expiration date as well. Okay, and here's the thing now: more the uncertainty, higher will be the implied volatility. If there's like the markets are just going crazy or over some certain news, the IV will go higher. Like if there's any uncertainty on the price section, it can influence price section. It will be influencing IV as well. But let's see how implied, like couple examples of implied volatility. I actually picked this up from Google. But as you can see, this is implied volatility. Prices were going up. IV went up. As soon as the earnings came out, IV dropped, right? So IV, after the event, IV dropped. So we went from literally 80% IV to like 10% IV, right? This number is always, you have to, if it's 0.1000, that means 10%. So then after that, for the next earnings, we kind of came higher again, and even the price was going higher, but the IV was dropping. That would have killed your premiums as well. Even though prices were going higher, it will kill your premiums because your IV is dropping. Okay, now we are rising into the next report. So we are slowly rising the implied volatility upwards for our next earnings. Okay. Now, what does implied volatility means for options. High IV makes the premiums of stocks very expensive. As I showed you guys example of GME before, I'll show you guys example again. GME was trading below the Apple. I think it's trading at 128, and we have premium sitting at $16. Here's it. It just plays up a little bit, man. It doesn't show me the premiums, all the premiums, but we understood, yeah. So this is quite higher than what Apple had on our right here. So Apple add the money, or in they're quite cheaper than what the other ones are. GME, even though GME is a little bit cheaper, it's just because high IV makes the premiums of stocks very expensive. Okay. Higher IV changes the potential range of the movement in the stock changes as well. Okay. If the IV is high, that also changes the potential range. Like if why Apple just moves a couple of dollars, because the IV is pretty solid, like 30% on it every week. But on Tesla, there's like 60-70% IV, and it moves like 10, 20, 30, 40, $50 a day. Then because the IV is like a little stronger, and they are already expecting the move. So higher the IV, higher would be the premiums of the stocks, as it affects the extrinsic value or the time value of the option premiums. So higher the IV, higher would be the premiums of the stock. As simple as that, because extrinsic value or time value is getting affected as well. Now let's say if IV drops all of a sudden, and your contracts prices can take a hit as well. I'm thinking the word should be will take a hit. If the IV drops off all of a sudden, your contracts prices will take a hit as well. Okay. Now we have, how can we use historical volatility and implied volatility? How can we use them like to make some extra cash? If historical volatility of options is sitting at 30% and the implied volatility for the week coming forward is 60%, what is that telling you? That means options are implying a 60% movement, which shows increased volatility, right? So increased implied volatility means that it will have higher premiums, like what you would buy on Apple, like maybe $2, because the IV pushed up a little bit, the premiums will be a little bit more expensive. Like I showed you example of GME and Apple. Okay. For example, if the contract's usually at $5, they will be sitting at, let's say, $6 now, because after IV comes down, which can be due to event, but after IV comes down after the event, that means premiums can go down to $5 at his historical value again. Okay, so it goes basically like this, goes higher, comes down again. So this is like $5, $6, and back to $5. If the price actually stayed the same, and the theta is not affecting. Okay, got some more points for you guys. How can we use historical volatility and implied? If historical volatility of option is sitting at 40% now, and the implied volatility of the week coming forward is sitting at 20%, right? That means options are implying just a 20% movement, which shows decreased volatility. Now, decreased implied volatility means that it will have lower premiums. Like something, for example, if it was costing you $5, will cost you $4 now. But after the event, after the IV goes back to normal, those premiums will be back to 5. Not especially those, the one that we were trading, but at the money premiums of the company will go back to normal. Okay. Now, I think we just did this. I think we just did this. Oh, there's a little mistake here. Okay. IV, rushes, and crushes. So far we spoke about IV, everything historical IV, everything done. And now, IV rushes and crushes. Remember the example that I gave you a few slides ago? This? We're going to talk about this now, right? So IV rushes and crushes. So right before the earnings or any company announcement, we always see a spike in implied volatility. It's just something that happens always. Doesn't matter what name it is, doesn't matter what it is. We'll always see increase in IV. And that's why I always say, or you'll hear me saying it, or Baron will be saying it, or any of the moderators or OGs, people who have some experience, they'll be saying as soon as earnings, earnings come out the next day, we always say, don't get crushed in the IV, because what happens is IV is so high, IV comes down. Remember the example from GME and Apple? So when the IV comes down, the premiums take a hit as well, even though the stock price is moving higher. And you'd be like, man, why is my options taking a hit? The price is moving higher. That's because IV is coming down. Okay. So after the company reports earnings, very important for first 15 minutes, leave that thing alone. Because even if you guess the stock, if it starts dropping and you are ready for it to drop and you are in puts, IV would drop and you'll still lose money. So there's no way in the first 15 minutes, like you have to make a crazy move up for you to actually get money. So the risk to reward is not always the great. Yeah. So first 15 minutes after the company reports earnings, my experience says, sit cash, don't take a trade on it. And just there's no rush. Right? Okay. This happens because of market makers are taking on extra risk, as there is a lot of uncertainty to the price after the earnings. Have you guys ever noticed, like, we'll close at 100, but after the earnings, we're opening at 115? So market makers are taking this risk. They're taking a risk of, there can be a jump. That's why IV is always higher, because they have to protect their downside as well. I mean, they got kids to feed. They got families too, right? Everyone got to feed their kids. So they push the IV goes higher just to protect their downside, right? Never a good idea to just buy calls or puts before earnings. It's just a gamble. You'd show me one trader who have a consistency in just buying calls or puts, whatever it is, just like he buys some calls before every earnings, or he can guess the direction of. There's no way in the world, like maybe once, twice, 5 times, there's no way in the world he knows that, every single time. It's not a consistent source of income. It's called gamble. Okay, IV can drop 10 to 20% on, or sometimes even more, right after the market open, after the earnings, which will drop your contract premiums as well. Okay, so what is the best strategy to take before earnings? Like, what's the best strategy that we can make some money on, like before earnings, right? From my experience, best strategy to profit on earnings is buy before the IV rush happens, up to the earnings, and sell before the announcement. So this is what I'm saying. Like, let's say the earnings are on Wednesday, right? Earnings are on Wednesday on a name, and on Friday before the market closed, um, you bought some calls because the chart was looking nice. You bought some calls, and the chart broke out. And the next week, this is Monday. This is Monday. You bought some calls here on Friday. Monday price moves higher. Tuesday a little bit higher. Or even if the price didn't move higher, man, the IV would be going higher because IV rush is happening because the earnings are coming closer and closer. So, so right before, let's say on Wednesday pre-market, there's earnings coming out. So you know for a fact you can't trade options before in the pre-market. So that means on a Tuesday before the market close, you have to sell the one that you bought here, and you wrote the IV. And if the stock moved in your favor, that's like a cherry on a cake. If it didn't, but you still be making a little bit of money or losing very little money because the IV was pushed higher and the premiums got a little bit expensive. Like they got a little bit, dearer. Um, Selling options is the best way to collect the crushing IV. It comes with a risk, and you also need a margin account. And this is not our main focus right now because I think everyone here listening or who will be listening to these recordings in the future will have a trading account under $100,000, or if it's over 100,000, there's some other strategies you can use, but we'll talk about it some other day, right? Um, and then buy buy options for further out of the money. There's another strategy, buying options further out of the money on the either side, also called straddles and strangles. You can protect your, you can this is something you can do as well. But from my experience, my favorite out of everything that I've made a lot of money on is this. So what I explained to you guys before, right? now the things get interesting because we're going to talk about options Greek. Like the Greeks of option, it's something very confusing. A lot of people confuse themselves, but we're gonna make it very, very simple, man. Options Greek. So Greeks are used to represent the variables that determine an option's constantly changing price. The Greeks reflect how outside factors will impact an option's value as certain conditions change. We'll talk about every single Greek and how they influence, so you will actually understand what I'm talking about here. Option prices do not always move equivalently to the underlying asset price. Like you guys would have noticed, price will be going higher on stock price, but the options sometimes go like this. Options are pretty flat. So option prices do not always move equivalent to underlying asset price, and the Greeks help explain why. Greeks do not directly influence option pricing and will not indicate where an asset price will trade in the future. Instead, the Greeks are a way to measure an option sensitivity to ever-changing external factors. Their values are dynamic and will fluctuate as price and information changes. Okay, there's no certain way where you can tell by looking at the Greeks are like indicators, you can have a rough idea what's going on. This basically is something telling you what's actually going on why options are behaving this way and staying flat. So that's because of the Greeks, and we'll talk about Greeks. Slides. So on most platforms, Greeks are listed on the option chain along the bid-ask volume and open interest. And I showed you guys as well before. So most of the platforms you'll just see after the bids and ask, you'll see your Greeks. There are 5 types of Greeks, but the 5th one is not that common, but they only talk about delta, gamma, vega, theta. If you go over these individual on pretty much every broker, you go over these things, they will actually they will tell you what it is. Delta, that's a ratio of change in price. They'll try just as a refresher, so you don't have to always remember this because your broker will always do. But it's something that it's pretty easy. It's not hard. I'm gonna lie. Okay, now you guys got it around bid, ask, volume, open interest. We all saw the option chain, right? There are many elements to an option price. Time until expirations, implied volatility, changes in underlying asset price, and interest rates all impact the value of option. There are 5 main Greeks, and each relates to either the option's intrinsic or an extrinsic value. Okay, don't confuse yourself too much with this, but just know that on stocks, what moves stock price? Stock price is moved by buyers and sellers, right? What moves options? Greeks are a big influence on options. Okay. Delta and gamma are dependent on option spot and strike price. This is the first Greek, this is the second Greek. They are dependent on the option spot and the strike price and are therefore derived from intrinsic value. Theta, Vega, and Rho are determined by time to maturity, volatility, interest rates, all of which are components of extrinsic value. This is something nobody gonna ask you when you're trading, when you're about to jump in a trade. But this is just something. Delta and gamma comes from intrinsic value. Theta, Vega, and Rho comes from extrinsic value. Okay. Now, there are total 5 types of option Greeks. Okay. First is delta, then gamma, theta, Vega, and Rho. So there's 5 different things. Now let's talk about them in detail and you will never forget them. The way I'm going to explain to you guys, you'll never forget them. Okay. Delta. So, delta is a Greek that helps us get a better understanding of our directional exposure. Okay, just something, only thing that you need to learn. This is just an introduction a little bit. It tracks theoretical rate of change of an option price given a dollar increase in the underlying price. Right? So what do I mean by that? So let's say options are trading at $8.20. Have a delta of say 40 cents, and this is the premiums, and So if the stock price goes from 140 to 141, every $1 move will add 40 cents to the premium. So now the premium every $1 move would be $8.60. Now let's say stock goes to 141.5, the premiums would go half of this, just so roughly. There gets gamma added as well, but you guys just understand now. Premiums would be $8.80 because we made a 50-cent move. Delta is 40 cents and half $8.80. Okay, so this is basically just telling you every $1 move what it does to the premiums. All right. Strategies that are bullish will have a positive delta. What I mean by that, I mean is if you're going calls, you have a positive delta right here. But if you have puts, you'll always have a negative delta. There's nothing that it's just a thing that they try to confuse you. It doesn't change nothing. The premium still get added. Every time a stock drops, and it still gets added to the option prices. And they're just crazy motherfuckers. Strategies that are bearish will have a negative delta. Now, I'll give you guys an example, actual written example. Let's say, okay, trading at $100, 105 call option has 0.30 delta and trading at $2.10 per contract. Okay, and K increases $1 to 101. The option should see an increase in price of 0.30 to, instead of 210, it will get added another 30 cents because we made another dollar move. Will be $2.40 now. All else stays equal. Okay. Some other factors impact on option price as well, but we are assuming those are frozen for this example for now. Okay. But now let's say if we saw K decrease by $1, instead of going from 100 to 101, we saw it coming from 100 to 99. We would see the call option lose 30 cents, and it will be $2 minus 30 cents, $2.10 minus 30 cents, $1.80, and assuming every other thing stays equal. All right. Now, delta put example. Now, stock K trading at $100. If 95 put options has a minus 0.4 delta and trading at $3.10 per contract, and K falls $1 to 99, that means we will see an increase in price 3.10 plus 40 cents. This minus is just to, I'll be honest, this is just to confuse you. It still gets added to your premiums, and your premiums go at 350. All else stays equal. If we say K increased by $1 and goes to $1.01, we would see the put option lose 40 cents. That was our delta. $33.10 minus 40 cents, $2.70. All else stays equal. And when you are doing, contracts, and sometimes your stop loss goes so wide. So this is like if you can risk $200. Let's say this is the maximum you can risk, and you're selecting options that are sitting at 40 cents delta. That means roughly, not exact number, roughly you can do 4 contracts, and you have a risk like you want to enter at 100 with a stop loss at 99.
and your profit target 102, that means you can roughly enter 4 or 5 contracts here. And if it fails, you can lose $200 because we calculate roughly it would be like 200, 220 after everything, gamma and everything added. But this is how we can also control our downside with options just by calculating delta and just having a quick. You don't have to be like really perfect with it. Just do a quick number in your in your mind, and that's pretty much it. Now, so you guys understood what delta is every $1 move, right? Now, gamma. What's gamma? So gamma is the Greek that gives us a better understanding of how delta will change when the underlying moves. So delta is the boss, right? Delta, like the names, like it's just the name of there's a little something different in the name, delta. And gamma is just assistant. He's running around delta. You're like, oh boss, I'll look after you. Just remember that way. So delta is a Greek that gives us better understanding and just runs after delta, basically. It's literally the rate of change of an option delta given a dollar move in the underlying. Now, same examples, the example that I was giving you before, where your delta literally goes 40 cents. So there's a gamma that sits just like quietly sits on the corner. And every time a stock makes a dollar move, and every time a stock makes a dollar move from 100 to 101, 102, your premiums are 820. Here, when it came to 101, this will be added. So it will be 860. But there will be a new delta come in, which will be here. It will be 0.45. This will get added in delta. This is gamma, this is delta, this is premiums, this is stock price. This will get added, and now we are 860. And now if you make another dollar move, this 45 cents get added. So we go 945. And now new delta becomes, add another 5 cents to it, 0.50. Right? You guys understood what I'm trying to say. I'll show you guys a better example, a bit better than this. For example, if a long call option has a gamma of 10 cents and a delta of 50 and the underlying moves by $1, the option will then have a delta of 60, all else stays equal. Now, gamma call example. Let's say stock KAY trading $100, and if 105 call options have 0.30 delta and a 0.10 gamma trading at $2.10 per contract, and it increases $2 to 102. Okay, for the first dollar gain, the 0.30 will be added to the premium because that was the original delta, right? It will be just 0.30 added, and it will become 240 premium for the first dollar. But gamma will be added to the delta on every dollar move until it gets to 1. Delta can never be over 1. That's a limit for delta. Delta is like, because delta always wants to stay at the top, right? Delta cannot go over 1. It's always at the 1. If it gets to 1, it's gonna stay there. It can't move anymore. You know what I mean? So this get added. Now, what will happen here is, so in this case, the move from 100 to, like here, I gave you example here, the first dollar move will have 30 cents added, and the next dollar move from 101 to 102 will have 0.40 as delta. 0.30 was the previous delta, plus gamma will be added to it, making the premiums go to from 240 to 280. Okay. Now, gamma put examples. So again, stock KAY is trading at $100. If 95 put options has a 0.30 delta and 0.10 gamma, trading at 3.10 per contract, and KAY falls $2 to 98. For first dollar drop, the 0.30 will be added to the premiums, making them 340. You see this? 310 plus 30 cents, 340. But gamma will be added to the delta on every move until it gets to 1. So in this case, the move from 99 to 98, because we're doing puts, will have 0.40 as delta. The previous delta was 30 cents and the 10 cents was the gamma. And it will make the premiums go from 340 to 380. Okay. Now, gamma is our friend. I love gamma. She's our friend. She's our friend. Gamma is friendliest to long option holders. It accelerates profit for every $1 move the underlying moves in our favor, and deaccelerates losses for every $1 move the underlying moves against us. So now remember how every $1 move the delta increased. So every $1 move against you, it will also keep taking stuff out of delta as well. So it works in our favor, and it also works in our favor in both ways. Okay. Since delta is the rate of change of an option's price, and gamma increases an option's delta, it would move closer to or further in the money. In the example in the previous slide, the delta would just continue to increase. Every dollar the underlying increase would result in more and more efficient returns on investors or traders' capital. Right? The phenomenon here also deaccelerate losses, as it works in the opposite way for every $1 the underlying moves against us. Right? Now, so we understood delta, right? We understood gamma. Let's just cross this. Now we have theta and vega and right. Okay, let's go further. What is theta? So just remember T for theta and T for time. As simple as that, right? So theta represents the effect time decay has on the value of options. So here's the thing. Options are a decaying asset. Option contracts lose value daily over the passage of time. The rate at which the option contracts lose value increases exponentially as options approach expiration. Theta is the amount the price of the option will decrease each day. Have you guys ever noticed that it goes like this? This is the premiums, this is the time. So on this is Monday, Tuesday, Wednesday, Thursday, and Friday, boom. Right? Monday, the premiums will be expensive. Like they're bloody expensive. Tuesday, it's like still all right, not bad. Wednesday, it's still good. But as soon as Thursday hits, it's really, that's why it's called Theta Thursday. We start going like here, since here it's just like, a smooth journey. As soon as Thursday hits, we just like starts going down. And Thursday and Friday, just crazy. That's why premiums get so cheaper. Okay. Now, that's because of theta. For example, a theta value of minus 0.02 means the option will lose 0.02 or $2 per day up until it gets to expiration. So here's an option chain again. So this is our delta. This is gamma. This is theta. That means every single day up until expiration, we'll keep losing. This day, we'll lose $18 on our options, on this option. That means by end of the day, if everything stayed the same, let's say everything stayed the same, no one transaction, this would be just sitting at $2 because $18 will be deducted out of this. Okay. Theta always represented in negative terms because the portion of an options value related to time is always going down. Theta always comes negative because as we move lower and lower on the expiration, theta have to get deducted. So time is we're running out of time, so it just goes lower and lower, and that's why it's in negative. Theta value is smaller further away from expiration and is not constant. It accelerates more rapidly the closer it gets to expiration. Now I'll show you the example. So now we will go to little over, say, all right, we'll go 146 days, or let's go 83 days. Okay, just check this theta out. Just see how it's just $5 or $6 at the money. Okay, or we'll check the 150 strike. Make our life easy. Just the 150 strike, theta is sitting at 6 cents, right? And now we will go a little bit closer to expiration, a month, now a month closer. 150 is sitting at nearly $7.5. And now we'll go closer, a little bit more further. 150 gets to 8, then almost 9. Now as we move in higher, 150 sitting at almost 11.5, and this week's sitting at almost 18. So it goes like I told you, it goes like this. More the time we have till expiration, the longer it's gonna take. But as the expirations are coming, it will just keep going lower. And you will realize on Friday, this number would be going crazy. It'd be like, because everything gonna go zero that day, right? Okay. So you understood the point. Theta value is smaller, further away from expirations, and is not constant. It accelerates more rapidly the closer it gets to expiration. Theta is an advantage for option seller. For someone who is selling options, it's good for them because when premiums go down, they make money, and they want theta to come out of the options so that they can make some money. It's good for option seller, but it's not very good for option buyers, right? But I found this little good photo on the internet, power cycle trading, and I just found it on Google. Credit to the owner of the photo, but what happened here? Theta. Think about one thing. The time value of an option contract decreases at an accelerating rate as expiration approaches, right? Time decay from 120 days to 90 days is the least. Then we pick up 90 to 60 days. It's a little bit higher, but then 60 to 30 days, it's still all right, and anything under 30 days picks up really fast. Just to make your life easy, just think of this little dude right here. This little dude right here. He's sitting on a bicycle.
They're sitting there, right? Just think of him rolling down the hill. At the top of the hill where he's just picking up, it's a bit slow, right? It's a bit slow, bit slow, bit slow. As the bike continues down the hill, it's still slow. As it continues down the hill, it picks up and boom, it crashes. Yep. Who would think that treated the bike pretty good? Um, okay. So you guys should be able to understand theta pretty nicely now. So for example, time decay increases more rapidly from 60 to 30 days than from 90 to 60 days. It's still a 30-day period, but from 60 to 30 days, this period is a little bit higher, quicker in decrease than this, okay? Now, Vega. See V for Vega, V for volatility. It'll make your life simple, okay? Now, Vega measures the rate of change in an option theoretical value given at 1% change in implied volatility, right? So every 1% change in IV would change this much on the individual name. Vega's impact on option pricing. Vega is a strong contributor to option price movement day to day. Just like other trading Greeks, Vega values will be positive or negative depending on the puts or calls, whether the strategy strikes are in relation to the underlying price and whether implied volatility is expanding or contracting. Vega will affect prices. Long options have positive Vega, short options have negative Vega. The key thing to remember is that Vega is representative of extrinsic value changing, not intrinsic, because volatility is extrinsic, not intrinsic, okay? If an option has a 0.05 Vega and the expirations implied volatility drops from 50% to 45%, right? So that's a 5% drop. The option will lose 25 cents of value. How is that? Because it's times 0.05, 5% gets this, and you do the maths, man, it comes to 25 cents. Okay. Because we dropped 5% on IV, and now I'll show you what this looks like on the option chain. So this is Vega here, right here. We have nearly $7 sitting on, with nearly 7 sitting there. And if IV picks up a little bit, it will get added to our, this will get added to our option prices. But if IV drops, it will be timed by how much it dropped, and it will get deducted. That's why when I said let the IV settle down after the earnings, because IV is dropping 20-30%. So that 30% is getting multiplied by this $7, and that becomes $2.10, and that's a lot of money, and that's why people lose money when the prices are going with them, right? So as volatility increases, and options price increases as market participants anticipate an above average move may be possible before expiration. Vega decreases as it approaches expiration because there is a less time for volatility to occur. just pretty simple, man. If it's Friday and what are the market makers expecting? They're expecting it to go do nothing. They want it to do nothing because they're happy with it is, right? They're not expecting nothing. So the Vega would be super low in those days. Okay, that was my cat. Okay, now Vega changes due to IV expansion. When implied volatility increases, strategies that are net short premium, like credit spreads, will suffer from an increase in Vega and extrinsic value. If an option or spread is trading for more than it was sold for, if the option or spread is trading for more than it was sold for, the result in marked loss. Keep in mind, however, there's an expansion in IV does not necessarily mean a trader with a short premium setup will have a losing trade at expiration. This is just some stuff that good to know. If a trader is in a long net premium trade, an IV expansion or increase in Vega is typically beneficial. Okay, this is something that you guys need to know. If you're in a trade and IV expanded, that you'll get benefited times the Vega, how much it increased, right? So Vega also have this, like if implied volatility collapses during the lifespan of a trade, this is beneficial to traders selling options, right? Or credit spreads. Now, as IV decrease, Vega and extrinsic value are also decreasing. So traders can often buy back their trades for cheaper than they sold it for. This is for the sellers, people who do option selling. On the other hand, decrease in IV and Vega are not beneficial to those in long premium trades. So I'm pretty sure you guys understood what Vega is. So I'm going to cut that off as well. But let's talk about ROI. So what is ROI? I know a lot of people, this might be a little new, not a lot of people talk about it. It's kind of the forgotten one. Nobody talks about this. They don't like it because we don't use it that often in everyday life as such, everyday trading. We don't use it, but still good to know. If implied volatility collapses during the last, man, this, I swear to God, hang on, give me 1 second. Oh yeah, I need to get the strikes up. Hang on. Yeah, okay. I haven't actually got the slide for row. I think I made it. I remember, but I misplaced it. But I'll just explain what row is, just in try to keep it simple. So row is basically on every every 15, every 25 cents, every 1% when the interest rate changes, how the premium's gonna change of bigger on the bigger picture. But this is something that interest rates do not change every day. This is something that you really do not need to worry about every single day. It is like every once in a while, but but it's good to know about what ROI is. It's just rate and change of interest rate and how it's going to affect it, how it affects our premiums and stuff. So that's right. And most of the option Most of your brokers will not even have rho on it, but just so you know. So we understood delta, gamma, theta, vega, and rho. And let's go over next slide now. We have option volume and open interest introduction. Now this is something that you all will like. This is more about how to choose a strike price when we trade, how to be in a right strike price rather than trying to be in a wrong strike price. And even though the contract moves in your favor, you lose some money, right? Okay. So trading volume and open interest are two metrics used to describe activity and liquidity within the options market, right? Trading volume is one of the most important. Every single day, we use this every single day. Like right here, this is something like this got traded 25,000 or 28,000 times. This one, on Friday. So this is the rate of the change, changing hands in the market. So trading volume measures the number of option contracts traded during a specific period. Like today, like on the option chain, we just saw 1 day volume. Like if you go to the volume on the top, it tells you volume for the day. See that? That's just volume for that day. Open interest measures the number of active options in the market at any given time. So that means people who are holding open positions on those many option contracts overnight. So this means this gets added. So this is a number from Thursday, right? The number from Friday we don't see up until Monday open. So this is a number from Thursday close up until Thursday, because after Friday we're going to see the Friday numbers on Monday. So this is someone people had 40,000 contracts open of 170 calls, 40,000 open overnight up until Thursday, right? Some of people, they also do this just to exchange shares, or just cover the short position. There's so many, or even they have to report the numbers. You can just say that they have already placed the order of buy. But we all understood this, that how open interest and volume kind of works. I'll give you some more examples and in detail. What is trading volume for options? So trading volume refers to the number of option contract buyers and sellers that are exchanging hands during any given period using usually a trading day. It is monitored for individual stocks and can be summarized for sectors or entire markets as well. Like we can check volume on literally the whole market. The PC ratio, puts and call ratio, you can check this stuff. For overall market, how many puts have been bought or traded today, how many calls have been traded today. Trading volume for option is calculated by totaling the number of contracts that transact within a day or up until that time. So let's say it's 9:35. It's 9:35, 5 minutes in the market open, and you see everything with low volume, but then you see this one with 105K volume. That means they had a lot of volume and had a good open interest as well. So yeah, that's good. If you want to trade, do not use anything else. Choose this. Right? It can be whatever strike it is, mostly at the money. So you choose this. Don't choose something that have less volume. Okay.
For example, if 5 trades collectively buy of 200 of a specific put option contracts that has the same strike price and expiration date, then the trading volume for the contract for that day is 1,000. You have to be here trading volume for the day is 200 because 5 trades have done. Total number of they have bought 200 put options, so the volume at that given time is 200. Okay, as a metric, trading volume helps investors and traders understand how much activity there is in the market for particular option contract. Like we want to buy the option contracts which have some volume. So even if the price does happen to go against us, the bid and ask spread will not kill us, right? We won't take a big loss just because of the bid and ask spread so wide. So we have to be aware while we try to pick option the strike price. We got to be aware of it. Okay. What is trading volume for options? Trading volume helps investors and traders understand the liquidity of an option contract. If option has a higher trading volume, that means there are currently large number of contracts actively changing hands, and in general, that will make it easier for an investor and trader to open or close a position and obtain a favorable price. Okay. Now, while trading volume helps indicate activity in a stock, it also shows the number of contracts and not the number of buyers or sellers. See what I'm saying? As a result, a single large purchase from an institutional investor might confuse us with a bigger activity that is actually happening on that option. So we might think, oh, there's 20,000 volume already and it's 10 minutes. But it could have been that big individual institutional investor actually bought 5,000 lots 4 times. And it's just him. And we're thinking everybody else is in there as well. Right? So this is a little something that you want to see the number go up slowly, not just like straight jumps. But this is something that we can keep an eye on. So therefore, traders use trading volume in conjunction with open interest. That's why I always say check the open interest as well. Don't just go out there with the volume, because volume can confuse you. You have to see for higher open interest as well. Like here, which one would you trade? Which one would you trade? I will trade this 61K. That is a 61K is volume. 19K is the open interest, and it's at almost in the money, like first step in the money, one in the money, and it's not very expensive. The bid and ask spread is very good, so I'll trade this because there's more volume, and there will never be a day that you will see me trading this, this 3K over this. I never do that. And you'll never see me trading somewhere deep in here, just to make a little bit extra money, or I want to take just a bigger trade, because the delta is what matters to us, and delta is best around either one strike in or one out. Okay. So at least like when the market opens up until 9:35. I would say you want to see at least 300 volume on options. Like in first 5 minutes, you actually at least want to see 300 volume. If there's lower volume, maybe you have to pass the trade at that given time. Maybe you should not take the trade because it's just the volume is not good enough. Okay.
So what is open interest for options? Open interest calculates the total number of open contracts for any specific options. Okay, that includes all long positions held by investors and traders that have been opened but haven't been exercised, closed, or expired. So, as I said, those are the expirations that are open overnight and they haven't closed them yet. Okay, open interest is tallied by option clearing corp. So there is a firm that actually sits there and they do these maths. They have, let's say, jobs OCC. They update every night, each night from all the transaction posted for the day. They update it and and it does not change during the day, because the whole point is we want to see how many people are still holding overnight, like what the word says, open interest. What's the interest uh, at this stage of the people? What's the open interest? What's popular? What everybody thinks, what all the traders, how much they're interested in this. Okay, um, open interest will rise after an option begins trading as investors and traders taking on new positions. It will then either rise or decline on any given day as a result of new positions, positions closed, or options exercised the previous day. So every day the number changes because some people do get in or get out. In conjunction with trading volume, changes in open interest can tell a trader when a lot of open volume option volume is just trading versus new traders taking position or existing holders closing position. So that's why we want to see we want to see trading volume and open interest both at the same time. Okay, um, I'll show you. There will be, like, if you go further out of the money, let's say this here, and you go, nah, let's pick a like decent number. End of this year, open interest, not much. Next year, maybe a little bit more. So these all open interest, like you see this stuff right here. These are the positions held by these big traders who are getting in, still buying and buying and buying. And the furthest 755 days away, they still have 13,000 open interest open there, sitting at 150. So this money, like, you guys will have no idea, this money moving in literally every single expiration, every single second of every single strike of the day. Okay, so you are going in there just to catch your piece. You catch your piece and you get out, right? This is all we want. There's so much money on the table, and we want to catch our piece and we want to get off. And that's pretty much it. Well, you try to catch the whole thing, and it gives greed, and you stay in the trade. But let's get back to your option class. So, what is open interest for options? I'll give you some examples here. For an example, if on a given day there are 350 open interest on a particular call option, and that day 280, all right, so 380 was the previous number. On that day 280 new positions are opened. So 280 positions were opened, 120 positions are closed, minus 120, and an investor exercised 75 of those contracts, minus 75. So that number would be the open interest for the next day, which will be 435. Okay. Now, what is high open interest? some people be like, what is high? Like, what should I look for? What should, like, just, if an option has high open interest, it indicates that the option might be particularly liquid, making it easier to get a timely and favorable execution on both buy and sell transactions. Okay. For that reason, it can help traders choose which option to select from the 100 available on a given stock. Like, there's so many options, and there's so many options out there in front of your eyes, and you just want to choose yours. Like, this looks very good, and you want to trade that. There's so many options. Don't just go, go crazy, and always look for somewhere around here. That's why I'll always have like probably like 8 strikes of my names up. I never have too many on. I'll try to keep my numbers as small as I can. It makes my life easy, right? So I would definitely recommend the same, 8 or 10 strikes, and don't make it too hard. As with trading volume, open interest also does not tell traders why the options are being traded and whether those trading them hold bullish or bearish positions. Now they could be short 20,000 shares, and you'd be like, nah, but we don't know if it's a bullish or bearish position. All we know is, there is open interest, and that's why we want to see do things at the same time. Open interest and the volume we want to see at the same time. That's when we know that option contract is a good one to trade. Okay. Okay. What is liquidity? Why is liquidity so important while trading options? Like, you might ask me, like, man, all I want to do is 1 contract, 2 contracts, or 5 contracts. Why do I care about thousands of volumes? So traders can use trading volume and open interest to better understand market movements, identify trading opportunities, or select the option contract to fit their strategy and objectives. Right? So options with some liquidity, like, you want to trade options with some liquidity, right? And volume can also be more profitable to trade, since you are more likely to find willing sellers and buyers and obtain a favorable price for your position. So when you want to get in, you do not want to pay too much spread. You don't want to pay $50 in spread where your position size is 100. You don't want to do that. So that's why trading with more volume and open interest is good, where your spreads will be tight, and you will be able to get in quick and get out quick as well. Okay. When an option is not very liquid, the spread between the bid and offer will be wide, and it will be more difficult to get the price you are looking for, thereby forcing you to accept a lower price for an exit or pay a higher price for an entry than you might want. Like, this is a thing. I'm pretty sure everyone here would have gone through phases where you entered a contract and the bid and spread is so wide, and you just can't get out even at the bids, and you have to go further below the bids to sell. And it's just because that's why liquidity is so important. Also, if your order for an option does not get executed in a timely fashion because of the lack of liquidity, it can result in you trying to chase or missing out on a move. It's very normal that I see a lot of traders that they'll try to get in here, but they choose the wrong option contracts and they will fail to get in. And then the stock's moving price higher, 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 and then they expect the same movement on some other name, and that doesn't happen. So what ends up happening is this, and that's the confidence gone. So it's just because you missed this because there's a problem. The problem is not the market. Problem is you picked the wrong
wrong strike. And if you don't identify the problem, you never fix it. So it's better to identify the problem and you so that you can fix it. Okay. Active option traders view liquidity as a very important criteria in selecting and executing their plays. Like you asked me, for me, maybe the this is the most important. I want to see liquidity. I want to see bid ask the least. I don't want to pay too much in bid and ask. Like I'll show you an example right here. Look at this. So we just have 816 volume, and look, 860 and 950. That's $90 spread. That's over 10%. That's like nearly 10% of this thing, of this option. So if you buy at the ask, you're already down 10%. If you have to sell at the bid. So if you see this option strike, it just have a $3 spread, and it's much more likely that you will make some money if the place goes with you. You will not lose a lot of money if the place doesn't go with you, because there's some volume and there will be some buyers who try to buy from you when you're trying to sell. Okay. Yeah, man, I was drinking water, bro. I was drinking water, man. Everything's all right. Can you guys hear me? Okay. So bottom line for why are they so important? So why is option interest and volume so important? Like, that's a bottom line now. Let's just finish this topic after this. Option trading, volume, and open interest are metrics that help traders better understand and interpret market action in both the option themselves and in underlying stocks. So if you are picking an option that doesn't have a lot of volume, guess what? You're fighting with two things, right? You're also fighting with the option and you're also fighting with the stock. And overall trading is hard enough. So just do one thing and just try to learn how to pick a perfect option contract. Okay. They also provide a gauge on how liquid and option contract is and how easily it will be to favorably open or close a position in it. While both metrics have limitations, when combined with other data, they help traders understand option liquidity better and make better informed trading decisions. All right. Now you guys, this is the topic for everyone's here for. How can we flip premiums? Now we have learned everything about options, but how can we flip premiums? Like, how can we flip them? So this is what we do. This is the day trading mode. In simpler words, calls are you're betting for the prices to go up. Puts are betting on the prices to go down. Now, buying contracts with anticipations of value increasing, we will benefit if the stock moves in our favor. Option contracts move up and down based on many factors, but primarily due to movement of the underlying security or stock. Okay? You can both day trade and swing trade options in order to profit from the movement in the underlying stock. As simple as that. Right? Now, we want to pick a strike with a volume at least 1,000 by 10 a.m. and open interest closer to 1,000 or more. Okay? Just write these notes down. If you are looking at upside, find your call before. Now, here's the thing. if you are looking for upside plays or downside plays, one simple thing, one simple key I can tell you is before the market open, just pick your, write it down on a piece of sheet next to you on your bench, on your desk, where you like call, you're going to trade 160. If it's puts, I'm going to trade 155. And you write it down before the market open. You already checked open interest. And if this confirmed with volume, so you don't have to waste time with just checking open interest, comparing again. If it confirms with volume, that's good. So this is something that I used to do back in the day. Now I became it became a habit for me. I don't do it anymore. But back in the day, I used to write it down on a piece of sheet next to me, and I used to confirm it before entering a position. Now, if you're looking at downside, find your puts before market opens, which you want to trade, right? And now, so we had 80 people basically joined. So we had 80 people who joined before. And now we left with like 45, 44, right? So half of the people gone. So which is good, really good. Because, okay, my rules to successfully trade options. When I'm trading options on Monday, Tuesday, Wednesday, I always buy the same week expirations. I know for us as zero DTE, we love zero DTE, but I will make another video. I'll make another webinar on how to actually trade zero DTE. So, it will help people out in actually understanding. We'll do another webinar, or I'll drop a video on YouTube again on how to trade zero DTEs. That's Fridays. Okay. So when I'm trading options on Thursdays and Friday, I'll always buy next week expirations. Like this one, my simple rule. If I have a plan in the morning, I will buy the same week. But if I am looking for a day trade, like a little move, I'm going for next week. As simple. Because I don't want the Theta to kill me right here. I enter a trade. I don't want it to go against me. I just want to fight against the market. I don't want to fight against something else. Okay. If you are day trading options and want to maximize profits for the lower movement in the stocks, buy in the money options. When I say in the money, I do not mean you go up there $100 and you try to buy that. You see this Gamma have turned zero, Theta has turned zero, and we're so deep in the money, nothing's affecting it, and Delta is one, as we discussed. But anyway, so 150 is in the money, and to actually make some cash, if you're expecting if you're expecting a lower movement in the stock, you're looking at $100 break to go from 100 to 100, or probably 150, $100.50. That's 50-cent move, and you can catch in the money. It would pay you quite a lot than trying to catch an out of the money contract. But if you're expecting a significant move in the stock and you want to lower your risk, you can buy an out of the money option. However, they are more difficult to profit from, because when you go out of the money, the delta significantly reduces. Now, here's 20 cents, right? And even if the move happened like $1 with you, you'll just make $20, right? If it happened $5 on you, add it all up, you make $100 on a contract, right? But the spreads are so wide, they're like 40% already. See this, as soon as you get in, you down big, you're down 40% straight away. So going too far out of the money doesn't always pay very good. Okay. Now, so all option contracts have a specific delta and theta. Typically speaking, the higher the delta value, the better the contract. As you will see, higher volume in the option contracts from small, higher movement in the option contracts from small movements in the stock. And that will make you more profit from small moves. Out of the money contracts always have lower delta. Like just right here, I'll show you. In the money, delta is 50, 55, 60. As we go low, out of the money always have low delta. Like this is zero. Right? So out of the money contracts always have lower delta, and meaning you need an enormous move in the stock to profit on the contract. So typically, the more inferior the theta value, the more profitable the contract, as theta lowers the option contract value to a certain dollar figure daily. So theta affects option contracts every second of every single day. And if you're trading a stock like Tesla, you will see it as time ticks on. While not essential, you should look for option contracts with higher delta than theta, especially if you're swinging options. Okay. Now, I personally never trade 2.5 intervals. Me personally, I never trade these 1.52. I don't trade these 1.52s, 1.57. I never trade 2.5 intervals. I always trade the whole number. If they have 145, 147.5, if they have 145, 147.5, 150, I'll either buy 145 or 150. I want to try 145, 147.5, because it's much more easier to get in and get out of those 145s, 150s, because a lot of people trade them. Now, every option contract you enter, so every single option contract you enter must have the volume on the day and at least some open interest. Otherwise, you may have a hard time closing your positions, man. Simple as that. So now, 0 DDA. 0 days to expiration. Don't forget to like the video and subscribe to the channel. Keep learning, champion. So on Fridays, or if the markets are closed on Fridays because of holiday, we have 0 DTEs on Thursday, right? We do have cheaper premiums as they are expiring the same day. Theta is very, very high. On Fridays, theta is insane, which makes the premium go, premiums harder to recover if they go against you too much. So this is what happens. Stock price will go higher, but this pullback, your premium, if you entered here on the pull, at the top, and you're hoping it will come down, this is the premiums. They will never recover. Even though prices keep going higher, they'll be like, because the theta is affecting them so much. So that's why on I say to everyone on Fridays, do not hold anything. If you get in, get out. Don't worry about it. There will be chances to get in here, catch a move. Don't just think like you're gonna stay in the trade and just like, it's not worth it. You know what I mean? Gamma is high as well, which makes the premiums move too fast and at an accelerated pace. So gamma on a Friday is highest in a week. So the day it expires, gamma is the highest. So what happens? What's the gamma's job? Gamma is delta's assistant, and every time delta does something good, gamma gave him a gift. And every time a dollar move, gamma gets added and added and added, and that's why premiums keep moving higher and really quick. Okay.
there is way more risk involved as the underlying options have less time to recover in case there's a big pullback. As I spoke in this little thing right here, there is way more risk involved as the underlying options have less time to recover in case there is a big pullback. Like this pullback, there's no time for it to recover now. Okay. Now, if you do decide to trade your DTE, always select calls at the money as they are easier to profit from rather than far out of the money. Okay, it's much easier to make money on GDTE if you're doing at the money or slightly in the money rather than you going out of the money. That's why I always say people, if Tesla at the money or slightly in the money you can't afford, please don't trade it on Friday. If you can't afford Amazon GDTE right there, please don't trade it. The risk to rewards, I mean, it's not worth it. It's, if it moved in your favor, you may make a little money, but if it move against you, it will crash. The risk to rewards not pretty much, but like it's not good. So now, the topic that I added, which is called leaps. I added this because the market's kind of coming down. I think it will be a good time for all of you to be educated on what are leaps, right? So I added this so everyone can go out there and can figure out for themselves. So what are leaps? Leaps means long-term equity anticipation securities. So let's talk in more detail about leaps now. So leaps options are long-term contracts that give the buyer the right to purchase or sell a security at a fixed price on or before a given date. Okay, so leaps have expiration dates of at least 1 year, like at least 1 year. That's leaps. Because of their extended time until expirations, leaps provide investors a cost-effective alternative to buy or sell a stock. However, they also come with unique risks. It's important to understand how leaps work before investing in them. So what are leaps options? Like normal options, leaps give the buyer the right but not the obligation to buy or sell a security at a fixed price on or before a given date. The key difference is that leaps options have at least 1 year expiration date. So leaps can be used to speculate on direction of a stock or to hedge against potential losses. So you can be in big Apple, this is your Apple portfolio, you want to protect your downside. So you sell, you bought at 125 and you sell at 175. You sell puts for 175. Even if it kind of goes below, you still make some money. So it's like hedging. It's hedging positions. Or you can buy some puts for long term just in case the stock moved against you. This can cover your ass. This can cover your downside. Okay. The long-term structure of leaps give investors more time to generate profit and flexibility to adjust positions, but it also means the underlying security can move a lot over the contract's life. So let's say you bought leaps, right? Let's say you bought leaps on K. This is stock from K Capitals. You bought leaps $100 and you put 10K in it. Now, and a year later, it's trading at 180. So your leaps 10K would be significantly moved higher to like 40, 50, whatever the number would be. So leaps gives you, because over a year period of time, there's so much time for a stock to make a move. That's why leaps are kind of very, very favored by investors, because there's some time, there's good risk to reward. It's a good way to make some money. And another critical difference between leap option and normal option is the leap options are usually only available on a limited number of stocks. There needs to be enough interest from investors to make them available. Now let's see. This is Apple, right? We do have leaps right here. Like we can see, we have till 2024. But let's talk about maybe I'm not sure about GME, but we'll talk about GME. Not sure about if they would have any for very long term. Oh, they do. Maybe some small name can be. BCRX was like something that I was actually fully invested in. So we can see if they have any long term. They do. So there's some demands there, but you can see there's no weekly demand there. You see, there's no weekly contracts. There's only contracts after a few months because of lack of demand. But you guys understood what I'm trying to say, right? So they only make contracts when they see some interest on the name, right? So pros and cons of leaps. So extended time frames can lead to more profits. When you buy an option, you're placing a bet on where the underlying security price will be in the future. With leaped options, you have a much longer time horizon, which means you can place bet on a longer term trend rather than guessing where the market will be in a short term. So you can say the name capital, K capitals will be trading at $500 by the end of the year. That means you are bullish on the name, and and you have time as well. You have over a year for the stock to actually move. And if the fundamentals are strong, there are chances the prices can go higher, and so you will make money. ROI measures an option sensitivity to interest rate. Short-term options do not generally warrant ROI considerations, but leaps may be impacted by rising or falling rates. So leaps have more time for adjustment because of their long-dated expirations. So leaps give you ample time to adjust your position if it goes against you. Like if you see K Capital stock goes from 100 to 150, then comes down to 125. And the pullback happened in a month, so you had enough time to just see what's going on and adjust your position accordingly, right? Now leaps are less capital intensive than buying shares of stock. Many investors use leap options as synthetic alternative to a long equity position. So like remember the trader X tried to buy Apple at 155 and price went to 180, so he bought back at 155, and he made the profit from the at the difference. So leaps can pretty much work the same. So leaps are less capital intensive at that given time. And later on, you can see if you want to sell the contract and just get rid of it, or you want to buy back the stock if you land deep in the money. If you're worried about another security losing value, you can use leaps option to hedge against potential losses. Like if you see there's a bad news on a K Capital's name, and you like, okay, I want to control my downside. I have too many shares. I want to control my downside. You buy some long-term puts as well with 10K or 20K. If you have $200,000 in K capital stock and you buy long-term $20,000 puts, even if it goes against you, the puts will actually control your downside, right? Um, so one of the most significant advantage of leap option is that they can help you manage risk, like big time. You can sell them anytime. If you feel not comfortable, you can get rid of them. Um, Pay attention to implied volatility. IV is a crucial factor impacting option prices, be it short term, be it long term. IV impacts prices. High implied volatility typically means higher options premium. So buying a long term options when volatility is high may lead to a decrease in extrinsic value when the IV comes back. You know what I mean? Give me a minute, guys. I think my brother wants to go to the gym and his alarm is going off. Hang on. Okay. So advantages and disadvantages of leaps. There are always everything have advantages, everything have disadvantages, but we need to figure out, what will if it works for us. So let's talk about advantages first. I'm more of a positive person. Leaps options have a longer time frame, so there is more time for the underlying security to move in your desired direction. And leap options are less sensitive to underlying price changes, and they decay slower than short-term options. So you have quite a lot of time to make some move. But now there are some disadvantages as well. Leap options have higher premium than short-term options, requiring more capital to trade, right? And leap options are less liquid than short-term options, so bid-ask spread may be higher. Now, we'll see here. Let's go to, this is over a year, June 16th, 2023. See this, the bid-ask spread is quite wider because the volume's not much. Even 200. The volume's not much. The bid spread's still all right, but still a lot. 30, 40 bucks and $5. You see what I'm saying? And you need a lot of money if you want to buy at the money or even out of the money. You need a lot of money to actually trade this to put on size. You don't want to buy when you do leaps. You do not want to buy $1,000 worth. You want to buy 10 grand, 20 grand, 30 grand, something. You want to put some real money in it, right? Because the spreads are so wide, it's just hard to get in and out. So that's a disadvantage. So the way leaps are set up. So leaps are initiated like any other option contract. Any investor may buy to open or sell to open. So now when buy to open, that means you're buying a contract to open a position. That means you're going long. But sell to open can be you selling a contract to open a position. That means you're going short first. Okay. Position by selecting a contract from the option chain. You don't do anything special. You just click on this and you trade. just like how you would trade a normal name, nothing special. So the main difference is the expiration date must be at least 1 year in the future to qualify as LEAP contract. So this is over 365 days, right? So this is definitely a LEAP contract. This is 293 days. This is not a LEAP contract because it's under a year. Okay. The longer time until expiration will naturally means much higher premium as the option will have significant extrinsic value. Sweet. The Greeks, delta, gamma, vega, theta, rho play a large role in option pricing as the longer time frame means the option value is more sensitive to changes in implied volatility, interest rates, and price fluctuations of the underlying stock. All right. Now, how to actually enter and exit so you guys can actually figure it out for yourself. So entering leaps is same as entering normal option contracts. The premiums and other information will be available on the option chain. The options may be just bought like any option contract, like right here. Everything is in front of us on a normal option chain. Like we know pretty much everything now, right? Like how we can find out about the short-term chain. It's pretty much the same. The most significant difference is the pricing compared to short-term options. These leaps are very expensive compared to short-term, right? Leaps will have more expensive premiums, but that is the cost for having capital effective long-term exposure to stocks. I mean, you pay for what, you get what you pay. So exiting leaps is same as exiting short-term option contracts, nothing special. For example, if a long call was purchased to open the position, it will be sold to exit. Just as simple as that. But there is an impact of quite a lot of impact of theta on leaps. Like so, but there's a little bit like science behind it. So time decay will have a minimal impact on leaps extrinsic value for the majority of its lifetime. Time decay or theta increases exponentially as an option approaches the expiration date. So the more time until expiration an option has, the more opportunity the underlying asset has to experience price movement and the more expensive the option price. So typically the effect of time decay will not be significantly impacted on the option pricing until last 60 days of trading, of last 60 days of that. Okay, because leaps have at least 1 year of time value. Theta is significantly component of contracts extrinsic value. So just so if we have 300 plus days here, so it mostly affects right around the last 60 periods. Otherwise, it's pretty much going like this, right? So now there's another one. What is impact of implied volatility on leaps? Implied volatility has the potential to impact leaps significantly. If implied volatility increases substantially before expiration, the long-term contract will benefit a lot. Okay, so on the flip side, if you buy leaps when the IV was high, and now implied volatility can have an adverse effect on an option premium if the volatility contracts before expiration. The price of long contracts will decrease. All right. Implied volatility of Vega is impossible to predict and is relative. So what seems low currently may not be in the future. You know what I mean? So now there's another beautiful topic that I added. It's called gamma squeeze. Because I bet a lot of people have no idea about gamma squeeze. What is gamma squeeze? So the term gamma squeeze is used to describe the dynamic where an option contract's prices moves sharply in one direction due to changes in underlying asset. So this can happen when there is a sudden increase in demand for option contract, or if there is a news that affected the asset price. Okay, so if the news came out and everyone started buying 180 calls on GME, back in the day, so a lot of people thought that was a short squeeze. That actually started as a short squeeze, but it turned into a gamma squeeze really quick. Because everyone started, all these Wall Street bet people started buying calls. And now people who sold those calls, they were deep in the money and they were getting exercised. So they had to buy shares because they have to sell the shares back to the guy who actually wants them at $180 a share, because the share is trading at 400 now. So they were buying at 400 and selling it to this guy. And that created a gamma squeeze. And this guy who got it for 180, he would sell the shares at 450 and he would buy more calls. And it just created a gamma squeeze, and that's what actually happened. So gamma squeezes can be profitable. It can be a profitable opportunity for option traders if they correctly predict the underlying assets price direction. Okay. But this is very, very important. They have to correctly predict. However, prices can move rapidly. Man, prices move so fast on options, and predicting wrong will result in significant losses because IV picks up straight away. So if you're wrong, you will lose some money. But if you're right, you'll make some nice cash. So what is difference between gamma squeeze and short squeeze? So hang on. Oh, for some reason I haven't got the slides. Okay, so let me just, I think I remember them. Okay, so gamma squeeze is, associated with option positioning, while, it's mostly gamma squeeze is fully based on options. Like when people start buying options and they start positioning themselves in options, and to fulfill their demands now, option sellers have to go out there and actually buy the stock to sell it back to these people who are buying the options. That kind of creates a gamma. That actually creates a gamma squeeze. But what is short squeeze? Short squeeze is when heavily shorted stock, like how GME started, it was a heavily shorted stock, rises sharply and the positions of short sellers unwind, and it causes further acceleration. They were all short, so they're like, okay, if it stays below this level, we're going to keep shorting it, but it breaks the level straight away, and these people, their stop losses get hit. And now, because they sold their shares first, now that's how you short. You have to sell something first that you do not own, and then you have to buy back to make money. So now they have to buy back. So they were buying back. What does buying do to the market? That increase the demand and their prices go up. That's how we should see a short squeeze. And this can happen if unexpected news impacts the market as well. If all of a sudden there's a news that dropped or K Capital's name has won the university of the world or something reward, and if it was highly thing, everyone start want to buy that because K Capital will make a lot of money now, and will keep going. The price will move a lot more higher and quicker. So gamma squeeze occurs when there is an excessive amount of options buying. Like this occurs only when there's excessive amount of options, like same option, like can be 200 calls, 3 weeks out. So when a lot of people start buying it, that's when the gamma squeeze occurs, and that's why the prices go like, and it just doesn't stop, right? Um, Now, this is an example of gamma squeeze on Lehman Brothers. Everyone thought they were going broke because of the crash, and yes, they did a little bit, but they went broke actually because what happened was, if you read the history, if you read the thing, what problem was, so people started buying puts when they keep coming down. Everyone started buying puts, right? So now everyone's buying puts. So guess what? So the option sellers, they have to sell the stock. They have to sell the stock, right? You guys understand what I'm saying? Because the put buying increased so much, option sellers were forced to sell their shares. They were forced to sell their shares, like they had to get out. They couldn't get filled, so the prices kept going lower and lower, which made the gamma squeeze go so crazy, and we just couldn't take it anymore, and we went to zero. And this is because IV was pushing up when it was coming down. IV was pushing up, contracts were getting expensive, put buying was going crazy, and everything was happening at the same time. But with that crash, so that's a clean example of gamma squeeze on Lehman Brothers. You see, now, what is gamma squeeze on GME? So this is what happened. We literally went from, this is the first move that we saw. A little move went from $6 to $18. It's like still a lot of, that's 200-300%. And then everyone started buying. Everyone started buying and buying and buying. Man, we went crazy. We went so high. So many thought that move was short squeeze, but yes, the initial move started as a short squeeze. But it was more than that. It was just not a short squeeze. It was also a gamma squeeze. So on Jan 28th, right here, on Jan 28th, GME rose additional 92%, man, as members of the Wall Street bets just bought into call options. On that day, traders roughly bought, man, 1.5 million call options compared to just like, I think it was 150 put options, 150,000 put options, and they bought 1.5 million call options that day. So as a result, what happened? Everybody who had sold the calls, they had to go out there and had to buy the shares so they can sell it to them for whatever strike price they bought. So, and the result was in front of you. It went from $5 to 500, just like in days. Now, how do you trade gamma squeeze? Now, I spoke about the hindsight examples, but how do you trade them in real time? Right. So if you're an option trader, gamma squeezes can be an excellent opportunity for profit, but it's important to understand how gamma squeezes work and the risks involved before trading. Remember, a gamma squeeze can occur when a sharp increase in the demand for option contract occurs. This can be result in rapid increases or decreases in the underlying price as the option sellers add hedges to their options exposure, right? To profit from a gamma squeeze, you need to be quick and have reliable data source for option sellers positioning. And the best thing for this I like is the one that I use is in the link in my Instagram bio. You'll be able to see what all the smart money pretty much is doing out there. And so as soon as the squeeze starts, option prices begin to rise. Traders hope to buy option contracts before the prices go up too quickly. Then they sell these contracts when the prices increase significant, right? It's also important to be aware of the risks involved in gamma squeeze. If the underlying stock price does not move as you expected, or you thought there's a lot of people buying it, I'm gonna buy it, and it didn't actually move, because a lot of people started buying it, Vega and IV would be pushed a little bit, and it can hurt you quite a lot. And you went in there hoping to profit from a gamma squeeze, you'll end up losing money. So unusual option activity, short interest, and data on option sellers positioning can offer insight into when a gamma squeeze might occur. Typically, the price action happens fast and unwinds equally as fast as well. So it is very important to always have a defined profit target and defined stop loss in place. One thing, I think I caught a $100 plus move on GME on options back in the day, but I got it for downside. I never traded GME for upside. I got it for downside, and I knew for a fact, we were dropping, and we halted a couple of times, I think 2 or 3 times, and 2 or 3 big candles, we just dropped $80, $100, something. And I had a tight stop loss. I was bringing the stop loss lower and lower just in case, right? Now, gamma squeezes can be a great way to profit as an option trader, but you need to be aware of the risks involved, right? Now, conclusion, the ending bit. So I made my premium Discord for free because you guys are getting robbed by these Instagram investors, man. So if they say, if you give a man a fish, he'll eat for 1 day. But if you teach a man how to fish, he'll eat forever, right? So I got tired of these guys giving everyone the bare minimum. So I decided to give you guys a freaking full meal. I promise I'll keep doing these masterclasses for people so that I can add as much value and help as many people as I can. Hopefully, someday each and every one of you find the financial freedom you desire and join me on my balcony in Melbourne. Cheers. And this is the last chance for you all. If you do want to buy my book, as soon as I finish this class, this deal's off the table. So got a link in bio, and somebody asked a question. Okay, let me just finish this first. Time for questions now, guys. Okay. I really hope this was helpful, and please check the description box below if you want to join my free Discord, and also subscribe and ring the bell notification to get notified about my next video updates. Thank you, guys.